the market is underestimating the strength of the U.S. consumer.
I think the consumer is as strong as it's been.
As long as the consumer is spending, we will continue having a strong economy.
The evidence suggests it's an economy that's pretty resilient.
It's really the U.S. that is driving the world economy right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now, snapping a two-day winning streak on the S&P 500, pulling back from all-time highs in yesterday's session and looking for a firmer footing this morning, going into Morgan Stanley numbers at 7:30 Eastern Time. Futures barely positive. The single name we're talking about, ASML, the company that makes the machines that makes your chips. Down hard yesterday, down again today by 4%. Earnings released on accident yesterday, and those earnings, an accident waiting to happen. Bramo, a major downside surprise.
Yeah, they booked only about half the orders that analysts had expected. The shares plunged the most in 26 years. And a real question here about why. Is this just the differential between everything AI related and everything else? The idea of the industrial chips, and we see this with Intel? Or does this have to do with China, which accounts for almost half of all of ASML sales?
So let's go to China. LVMH. LVMH, absolutely dreadful. Check out this move over in Paris trading. We're down by 4%. And sales are down too. Fashion and leather goods sales dropping for the first time since the pandemic. And the quote from the CFO, take a listen to this, at a time when everyone's getting all bulled up about the prospects for China. Consumer confidence in mainland China today is back in line with the all-time low reached during COVID.
Well, that also goes to what Citigroup put out, and they sent individuals to China looking at a mall, and they came back with saying there's no improvement of luxury consumption after the recent macro policy pivot. Not just is it bad in China when it comes to LVMH, and there's some 75 brands across clothing, jewelry, hotels, spirits, but also in Japan. They're not seeing, because of the higher yen for the Chinese consumers, they're not seeing them spend as much there. Also in the U.S. and Europe. So luxury is not doing well right now.
So there are two questions here. And just to point out, this is the first decline for LVMH's sales going back to the pandemic. Two questions here. How much is this that China's economy is actually doing worse than people think? Or how much is it that China's economy has gotten that much more isolated from the rest of the world, where their benefit and their gain and their consumer appetite doesn't go to ex-China goods and materials?
Yes, both. I think it's got to be both, and that's a big, big problem. Even if we do get a big stimulus package out of the Chinese officials, how much will it boost the rest of the world? And to your point, perhaps not by much.
And it's very difficult to understand the policy landscape. Thinking about the Netherlands with ASML, this idea that they might be barred from selling to China, at the same time that China will be telling its own companies and individuals don't buy from them. So there is an institutional structural fissure being put in place at the same time that companies are saying, what am I going to do?
ASML CFO was very honest about what they see in China. They're calling it now more normalized percentage in our order book. So basically they're saying they think next year it's going to come around 20% of total revenue. In June, when they talked about it, it was 49% of its sales. So these hard cold numbers basically show you that is still not the avenue it once was for a lot of these major companies.
Two European players right now in focus for us all, ASML and LVMH. Looking ahead to Morgan Stanley numbers, 7:30 Eastern Time. Then looking ahead to retail sales tomorrow, 8:30 Eastern. That's the big data point of the week. Equity futures right now on the S&P 500, barely positive on the S&P. In the bond market, a bit of a rally. Yields are down by 3 basis points, just about holding on to 4% on a 10-year. An even bigger rally over in the UK. Lisa, speaking of downside surprises, CPI in the United Kingdom, a little bit softer than expected.
Basically, yet another example in Europe of why not cut, right? I mean, we've already said that with the ECB tomorrow, which is probably going to cut by 25 basis points. But now all of a sudden the Bank of England also seeing the potential for why not cut, given the fact that CPI came in below expectations. And they're facing off with the potential of growth also coming in soft.
We've got to wait for that budget from the UK as well, from the British Prime Minister, from the Labour government, and then November 7th. November 7th, Bank of England rate decision, the same day as the Federal Reserve. Coming up on this programme, Julian Emanuel of Evercore, with stocks coming off all-time highs. Elyas Galou of Bank of America on a bullish global fund manager survey. And Trent of Citi as United Airlines delivers better than expected earnings. We begin this hour with equities pulling back from all-time highs following a sell-off in the chip makers. Julian Emanuel of Evercore staying long big tech and writing the following. We remain fully invested in sectors and themes which are proven winners in the year after the Fed begins a rate-cutting cycle, including information technology. Julian joins us now for more. Julian, good morning.
Good morning.
I know we can't do single names with you, but what about one single name? What did you think of ASML? What do you think it means for the broader sector, for chip makers and tech stocks more broadly?
Well, look, again, you go back to this entire bull market cycle has been led by semiconductors in one way or another. Obviously, the AI theme, the primary driver. But it is definitely a question that opens up sort of the issue about why China did what it did several weeks ago and what the efficacy is ultimately going to be. And I think it also calls into the fact that this is one of these times where, you're seeing the weakness in China. You're seeing, the ECB is going to cut again this week. Europe is certainly not going gangbusters. And the U.S. really is, again, the isolated island of global growth right now. And that's not really healthy on balance.
It raises a big question about how we should process incoming information over the next month or so when we hear from more companies with greater exposure to the story out of China. How would you process that incoming information?
Well, look, the equity price reaction in China over the last several weeks tells you that there is at least a belief that something may change. It also tells you how incredibly underweight global fund managers are to the China theme. And look, this is the government has set a bar and an expectation, and it's going to have to deliver. And I think that the other question will be, what the election outcome is in the United States. And if you get a Trump presidency, which is clearly going to be at least incrementally, if not greater than incrementally, more difficult for China, what is the policy response to that?
You see a lot of potential volatility coming down the pike. You could see a scenario for 5,200 or you could see a scenario for 6,700, depending on a lot of different outcomes. We talked about the Bank of America Fund Manager Survey, and we're going to be speaking with them in just a bit. They say there are three prongs to the incredible bullishness that's been really in the market right now. One of them is the belief in a soft landing globally. One of them is the anticipation of Fed rate cuts. And one of them is that China policy stimulus that seems to be supporting some of this optimism. Which of the three do you think is most fragile?
I would say on balance, the China policy. Again, because we've heard what they said they might do. We saw the reaction in shares. But at the end of the day, you can argue that the structural problems in China are structural and take multi-years to work themselves out. In a lot of ways, it's almost the kind of negativity that you saw in 1982 in the U.S. when you came off of a decade of, really subdued investor confidence, a very cautious consumer, and incredibly horrible share price reactions.
Is that going to be enough to take us to the 5,200 projection rather than the 6,500 projection that you have for the S&P?
Well, to be clear, our year-end price target of 6,000, again, because of the difference in what could be contested versus an uncontested election result here, united versus divided government. Investors very clearly prefer a divided government outcome. But, you think about it, and an uncontested outcome in this environment where we've already seen the start of a year-end performance chase because the Fed green-lighted that on September the 18th with a 50 basis point cut. That's your path to what we would term a melt-up. But conversely, if you get the kind of contested election outcome that you got, say, in the hanging Chads year of 2000, when the Yankees and the Mets last met in the World Series.
And the Yankees won.
All right. Seriously, you're going to make this antagonistic?
History rhymes, but doesn't always repeat.
Okay, let's go to your gaming the Game of Thrones. Back to this idea of what's going on with the election. What does this mean for the stock market? When you say contested, uncontested, does it matter who the president is or just the fact that we were able to sail through this?
I think, again, this preference for divided government, given the acrimony in the country right now and the sharp policy differences and the idea that investors don't want the tail ends of either candidate's policies, is really the most important thing long term. Short term, again, it is a question of, we do not want to go through this questioning the freeness, fairness of elections and that process again, because that's a page that does need to be turned.
When you look at what the market wants, is this almost a self-fulfilling prophecy? Investors come on constantly and they say, our base case is Goldilocks, gridlock, that's Goldilocks. Isn't that what they want because it's good for the market? But are they actually looking at the polling data accurately?
I think there's an element of hope in all of this. I mean, let's get serious. Essentially, a week after Harris became the nominee, this thing has been a toss-up. It is a toss-up, all over the map. And in fact, if you look at the odds right now, the concept of both chambers of Congress flipping in the other direction, regardless of who the president is literally unprecedented in history.
Can we just finish up with a guide for where sentiment is right now? And I'm going to read two very different quotes, two very different views. HSBC, sentiment and positioning are still neutral. Max Cantor's been talking about poking the bears. He thinks people aren't bullish enough. Your old shop, BTIG, Jonathan Krinsky had this to say: fear of downside has left the building and fear of missing upside is front and centre. Where's sentiment? How can we have two completely different views about positioning and sentiment right now from two completely different banks?
Well, both the Bulls and the Bears are holding their desk, essentially, in front of the election. But what we would say is, coming into September, when we all know September has a history of being a negative month, the first week or so you had the flush out, and you had position having gotten light. But as I said, after that 50 basis point cut, you have regrossed. I would say sentiment is probably not overly enthusiastic, but certainly bordering there. And if we were to see, despite all this negative news out of the traditional semi-manufacturers, if you saw the AI theme lead further upside, sentiment could get enthusiastic very quickly.
This was an 8-minute conversation without talking about the Federal Reserve. So let's talk about the Federal Reserve. One final question. Is it the easiest job in Washington, D.C. to be the Fed chair? And would it be better if we just flipped a coin to make a decision?
We're very much in the camp that the Fed should be an independent entity. It is not the easiest job. I mean, if you think about the fighting the pandemic, then fighting an inflation that nobody saw coming. And here we are with arguably, not even arguably, the world's strongest economy.
Yeah.
And a recession that people have been looking for 2 years that has no signs of occurring. That's not an easy job, and it's been done pretty darn well.
Very diplomatic. Julian, good to see you. Thank you, sir.
Thank you.
Julian Emanuel of Evercore there. Equity futures on the S&P 500, totally unchanged. Just remember, Morgan Stanley earnings coming out a little bit later this morning. Retail sales out tomorrow morning. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. UK inflation slipped below the Bank of England's 2% target for the first time in 3.5 years. Consumer prices rose 1.7% in September compared with the year earlier. Traders are now betting on back-to-back rate cuts at the BOE's November and December decisions, having previously favored only one reduction. Shares of LVMH slumping in the Paris trade, down more than 4%. The luxury goods retailer reported an unexpected drop in third quarter sales, warned of an uncertain economic and geopolitical environment. It was the first decline in sales since the COVID-19 pandemic, all driven by slumping Chinese demand. A shareholder of 7-Eleven parent company 7 & I is urging the company to return to the negotiating table with Canada's Couche-Tard. The investor said that 7 & I's recent announcement that it was restructuring the company was designed to thwart the acquisition. It had proposed to split its business in half. So far, 7 & I's shares remain below Couche-Tard's proposed price, suggesting market skepticism over a possible deal. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the tariff man on tour.
To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. We're going to have thousands of companies coming into this country. We're going to protect those companies with strong tariffs because I'm a believer in tariffs.
A lively debate over in Chicago. We'll get you some of the details up next. Live from New York City this morning. Good morning. just a little bit of calm after a storm from the chip makers yesterday. Equity futures totally unchanged on the S&P 500. Bit of a change over at UBS. Jonathan Golub, new year-end target for 24-25. Target 5850 year-end, 6400 year-end next year. Just a nudge higher from the team over at UBS. In the bond market, yields a little bit lower. We're down 2 or 3 basis points. The 10-year just about holding on to 4%. Under surveillance this morning, the tariff man on tour.
To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. We're going to have thousands of companies coming into this country. We're going to protect those companies with strong tariffs because I'm a believer in tariffs. I brought in with tariffs 2,000% tariff, the highest tariff in history. We're going to put tariffs on them, the tariffs. I put tariffs on China. I put tariffs on South Korea, the threat of tariffs. You're going to pay 100% tariff.
I think you get the picture. Here's the latest this morning. Donald Trump defending his plan to overhaul the U.S. economy through a series of steep tariff hikes and gaining more direct influence over the Federal Reserve. The Republican nominee dismissing the notion that the policies could have a negative impact on the economy and for U.S. consumers. Bloomberg's Katie Dines joins us now from the nation's capital for more. Katie, just how popular is that position?
Well, it depends on who you're talking to. If you're talking to most economists, the prevailing wisdom is that this would be inflationary policy. If you're talking to blue-collar voters in some of the key swing states that ultimately will decide this election, this is a little bit more of a popular idea. These notions of populism is protecting American manufacturers and making more things in America is something that resonates with many of these individuals who have found themselves supportive of Donald Trump's policies, many of them going back to 2016. Now, when Donald Trump was pushed on this idea that this could ultimately lead to costs for some of these very same voters I'm talking about going higher, he said no, because all you have to do is make your products in America and then there will not be a tariff. To actually quote him directly, he said, you make the tariff so high, so horrible, so obnoxious that they'll come right away, suggesting companies will come and start making goods in the U.S. I think we all know that supply chains don't necessarily reorient themselves that quickly. Factories do not build themselves overnight. And yet that is what he seems to be suggesting, that he's just going to force companies to come here in the U.S. through these protectionist policies.
Kayleigh, maybe not as aggressive as the former president, but the Biden administration has kept tariffs on that Trump first introduced. Is that working for them or not in terms of the campaign?
Well, it's an excellent point, Anne-Marie, and Donald Trump did point that out yesterday, that many of the tariffs, in fact, almost all of them that he put into place during his first administration has been left intact and perhaps even expanded in some instances under this current administration. Most people I speak with would say the differentiation here is, yes, you are likely to still see protectionist policy. You are likely to still see export controls going into place when it comes to China to try to limit their ability to develop critical technologies. The difference is the targeting. What Donald Trump is suggesting is blanket tariffs across the board versus things that could be more deliberate in the areas in which they are actually implemented. And that seems to be one key differentiation. All that said, we haven't heard as much about tariffs from Kamala Harris as we have from Donald Trump. I think it's safe to say it is not her favorite word in the dictionary.
The former president also said that he's going to be watching on election night. What he finds decisive is #1 Pennsylvania. And that's where Kamala Harris is today. And she's actually going to be speaking to Republicans, correct?
Yeah, she's going to be doing an interview on Fox with Bret Baier. This is part of a strategy we're seeing on her part in terms of media to reach out to voters that aren't yet with her, that she would like to see more support from, including Republicans. We have seen her trying to create this permission structure, if you will, for Republicans to cast a vote for her over Donald Trump. You've certainly seen that in, for example, the endorsement of Liz Cheney and the campaigning alongside her we saw earlier this month. And it's not just about reaching out to Republicans as well. It's about trying to shore up other parts of what has traditionally been the Democratic base. Yesterday, she was on with Charlemagne the God, trying to amp up her support among black male voters specifically, as we have seen polling, including recently from the New York Times and Siena, that shows, yes, she has improved her standing among black voters compared to where Biden was when he left the race. She is still not yet at the levels of black voter support we saw from Biden in 2020 when he was able to garner 90% of the black vote in what was a very tight election. And in an election that seems to be getting tighter and with margins that are likely to still be very small, that 10% differential, she has about 80% right now, could make a big difference.
Kayleigh, how many minds really are undecided? How much is this just a turnout game and trying to ignite some sort of enthusiasm in certain groups?
The basket of people yet to make up their mind is incredibly small, Lisa, and probably shrinking every day. As I would remind everyone, yes, we are less than 3 weeks out now from the election on November 5th. But the election day is one thing. The election already is underway. Voting has started in a number of states early, including key battlegrounds like Georgia, which began early voting yesterday and sent a record for turnout of more than 250,000 people showing up on the first day. So it is going to be about the game of driving people out to vote. And that is why money still matters here at this stage of the race. Yes, most of the ad buys are in, but having access to a larger war chest to be paying people to go out and knock on doors and actually do that driving force of getting people to the polls is what's going to be key here. It was also raised to me yesterday as we consider Donald Trump's remarks in Chicago, maybe more oriented toward the donor class. In some instances, the money is also going to matter after the election, as we've already seen so much litigation leading up to it, potentially could see very litigious activity in the aftermath if these results are contested. And it's going to take money to fight those fights as well. So both for turnout and then ultimately in the decision making, if you will, around what the actual vote turns out to be, money could be a big factor.
Kayleigh, you mentioned yesterday's interview with Donald Trump, and he did also mention the early voting, saying that signs are that he's capturing a significant majority of those votes. What kind of visibility do we have into that, Kayleigh?
Well, Donald Trump has had mixed messaging on early voting, frankly, Lisa. We have seen this over the past 2 election cycles. At one point in the same speech, he was encouraging people to go out and vote early and then called early voting stupid. We've actually seen a phenomenon, and especially in states like Pennsylvania, which, as Anne-Marie mentioned, he said is the one to watch, could ultimately be the deciding factor in this election with its 19 electoral votes. They can't begin counting those early mail-in absentee ballots until the morning of Election Day. And if it is skewed more democratically, those who are mailing in versus those who are not, given some of the rhetoric we have heard from Donald Trump and those close to him, we could see early in the count a skewed result toward Donald Trump versus what ultimately the final tally will be. So it's certainly a factor, but you are seeing a more concerted effort now to drive people to the polls early on all sides. And that goes for down ballot as well. If you look at the Arizona Senate race, for example, Carrie Lake, who was very against early voting, has actually already cast a vote early for herself and is now pushing it. So there's been a lot of changing narratives around this.
Some big changes. Katie, appreciate the update. As always, Katie Lyons from Washington, D.C. You can catch Katie alongside Joe Matthew at 12 and 5 p.m. Eastern Time on Balance of Power. Let's talk about these interviews. These are risks the Harris campaign would not have even thought about, wouldn't have touched a month ago. Fox News, Brett is the real deal when it comes to conversations like this. So this is a risk they just wouldn't have taken even a few weeks back.
And he's going to get 30 minutes. And he's talked about this interview and the lead up to it, saying he thinks it's enough time to really push her on some answers that he thinks the electorate is looking for. Look, they get half the eyeballs in the United States. And if you want to win those that are potentially still undecided, you have to go there. And what Harris is doing today, she's going to have a pit stop where George Washington famously crossed the Delaware River during the Revolutionary War. She is going after Republicans who potentially don't like the former president, and that is why she is sitting down with Bret Baier.
What strikes me is when she first entered the race, which was not that long ago, she was really the anti-Trump, and she was the candidate who is not going to be Trump.
Sure.
It has gotten to the point where every candidate who has gone against Trump has to realize they have to do more than that, which is the reason why a lot of these interviews are taking place.
The biggest challenge for her right now, Lisa, it's not just explaining the difference between her and Trump. I think at this point, that's pretty obvious. It's explaining the difference between her and Joe Biden, the President of the United States. When asked repeatedly on the campaign trail, they still haven't come up with a good answer for this. And I imagine Fox is going to repeat that question a little bit later.
They struggle with it, and that's difficult because then Trump can cast her as the incumbent. And the top 2 issues this campaign still remain in his favor, the economy and immigration.
Up next on the programme, we'll talk about the economy and financial markets. Bank of America out with a bullish global fund manager survey. That's next. This is Bloomberg. A ton of bullishness hitting a bit of a wall in yesterday's session. Equities right now on the S&P 500 totally unchanged. Snapped a 2-day winning streak on the S&P in yesterday's session. Financials held pretty steady, supported by some pretty decent earnings. Look out for Morgan Stanley a little bit later. But the losses were led by tech and energy. Thank you, ASML, and thank you, oil. And with that move in oil, we've got to bid back into this bond market, switch at the board and get to fixed income. The 10-year Treasury just about holding on to 4%. The 10-year this morning, Lisa, down 2 basis points.
It has to do with disinflation across the board and not necessarily some sort of inflationary pressure coming from the oil patch. I do wonder, people talk about the U.S. being truly exceptional. How much the U.S. is divorced from what's going on in the United Kingdom, in the Euro region, where suddenly almost deflation is a new concern, a renewed concern, I should say, for the first time since pre-pandemic.
So turn to foreign exchange. We'll talk about the UK. Pound sterling looks like this morning. The pound against the US dollar, 130.27, weaker by about 1/3%. Inflation coming in beneath the target of the Bank of England and beneath estimates this morning as well. On the headline read, cause a different picture, but headline inflation starting to improve, opening the door potentially for an interest rate reduction from the Bank of England on November 7th, and likely maybe also across the channel, looking at the continent, maybe from the ECB this week as well.
Yeah, the likelihood of a 25 basis point rate cut tomorrow is very high in markets. Key question continues to be what's the path and how much does that diverge from what we're seeing in the U.S.? Just to put some numbers on what they saw in the U.K., consumer prices rose 1.7% in September. That is below that 2% goal and below the 1.9% expected by analysts. How much are we seeing a return to the old trend? And that, I think, is something that a lot of people are grappling with, where remember the time when central banks actually were trying to encourage inflation, trying to generate it to prevent a lost decade akin to what we saw in Japan?
That was a different time. Pound sterling, 130.26. Yields are lower at the front end of the curve in a gilt market. The 2-year down by close to 9 basis points. Under surveillance this morning, ASML shares plunging the most in 26 years after disappointing Q3 earnings. The chipmaker booking only about half the orders analysts had expected and lowering its guidance for 2025. TSMC is set to report earnings tomorrow. Now, this is a question that is impossible to answer, but it is worth exploring. If they hadn't released these on accident, we still don't know what happened. If they had have released these and you got that accompanying commentary, you got that nice call afterwards to explain this big plunge in orders relative to expectations, do you think we would have had the move that we saw in yesterday's session?
I guess we'll have to know after the call, after that nice presentation. There was some speculation that this was almost deliberate. Just rip off the Band-Aid, get it out there, see what happens. Honestly, there are so many question marks about this. How much is this the fissure that we're seeing between AI and what we're seeing in Intel with respect to automotive, industrial, iPhones, et cetera, that those chips are having more of a problem than, say, the NVIDIAs of the world, which continue to be dominant. The China question is so difficult. How do you deal with a country that is so deeply political in terms of some of the policies around it, as well as a lack of visibility of whether consumers can buy in China and then what they will buy?
The geopolitics is very challenging for some of these companies when you look at export controls and even what the Dutch government as well wants to do, signing up with the United States. And the destination of travel is getting only worse, not better, even regardless whether or not it's as aggressive as a former President Donald Trump and his views on China or potentially Vice President Kamala Harris going to the White House. But whether or not it was deliberate or not, Cantor Fitzgerald says we could debate that. Clearly disappointing.
Two very different issues. They're connected, but two different issues. So let's break them up. You've got the cyclical weakness in China's economy. We'll talk about that with regards to LVMH in just a moment. And then you've got the policy issues down in Washington, D.C. And I think speaking to that story almost perfectly is this one. Sources telling us here at Bloomberg that Qualcomm will likely wait until after the US presidential election to decide whether to pursue an offer to buy Intel, the company looking for clarity on the antitrust landscape and America's relationship with China.
So I'm not surprised when I see this. Why would you make any massive move in a company when potentially the direction of travel may be the same but more nuanced when it comes to antitrust, when it comes to how you view China? Also, though, we should note, after the election may help Qualcomm. Intel report third quarter earnings later this month. So basically, if they're so bad, the share price falls, maybe they can get a better deal on this tie-up.
Oh, so you think that this is just a pure financial thing, that their shares are going to tank and then they're going to be the white knight to come in? Is that right?
Well, I just think it might help them and they can use the election as an easy excuse.
Yeah, well, honestly, I think that the bottom line is, why would anyone make a big move before the election with a major industrial company? Because you would just end up being on the campaign trail. And that's what we saw, certainly with U.S. Steel.
Julian Emanuel was just on this program, and he said bulls and bears are both holding on to the desk. You have to imagine C-suite executives are doing the same.
Do we really think the antitrust environment's going to shift that much under Trump versus Harris?
It depends if some of the donors on both sides can get in either of these individuals' heads, and we can ask Howard Lutnik about that.
I think you raise an important point. The market environment could shift markedly if it's Harris versus Trump. If it's Trump when it comes to China, whether it's reality or just perception, in the immediate aftermath of that election, perception will matter a whole lot more. And you'd have to imagine China gets sold, and gets sold pretty hard.
which raises a question of whether people are lining up to potentially buy on the cheap. I mean, you have to wonder what actually is a threat and what actually a negotiating tool and what actually is something that is actually going to go into effect. We don't understand this. So are you really betting on sentiment shifts or are you betting on reality shifts? Two different things.
I promised you an update on LVMH, so here it is. Shares dropping over in Paris, France, after sales of fashion and leather goods fell for the first time since the pandemic. The company citing slowing demand in China, organic sales in that region falling 16%, and the commentary from leadership, pretty awful.
Commentary was this: most of our markets currently face economic challenges, including mainland China. This is coming from the CFO. And they go on to say that basically consumer confidence in China is back in line with all-time low during COVID, when no one was going out and spending on luxury goods. That's how bad China is right now, even after we just had the stimulus measures from the Chinese officials.
Well, this is precisely why we had a very specific question when it came to the stimulus measures. And Lisa, you talked about it repeatedly. Where are the incentives for consumption? Just got a little bit. Not enough.
Yeah, and just in terms of whether it's domestic or international, take it a step further, are we underestimating the weakness the Chinese authorities saw currently in their economy that prompted this type of response?
LVMH down by about 4%. Here's an update on the Bank of America Global Fund Manager Survey. It captures a big bullish shift in investor sentiment, showing the biggest jump in investor optimism since June 2020 and the largest jump in global growth expectations since May of the same year. To dig deeper into the results, into the survey, Elyas Galou of Bank of America Securities joins us now for more. Elyas, welcome to the programme, sir. This is bullish. My first question to you, is it a little bit too bullish?
Hi, John. Look, I mean, this was really a global fund manager survey for the books. As you just said, you know, one of the biggest rise ever in global growth expectation. Look, this is a series that goes back all the way to 1994, and we saw in fact, the fifth largest monthly jump in growth expectation in the past 30 years. So yes, definitely a bullish survey, and for the first time in the past 3 years, positioning is also equally bullish. And I would say that, yes, the bulls are very much in control and have clearly led the charge in the past month.
Elyas, John pointed to this before, this idea that Max Kettner over at HSBC actually sees pretty neutral positioning. And you're talking about pretty bullish positioning. Which is it?
You just need to look at a few different metrics across the Global Fund Manager Survey to just see bullishness is very much spread across the different asset classes. The most important, I would say, is the FMS cash level. Again, a series that goes back all the way to the late 20th century. And that FMS cash level dropped below 4% to 3.9% for the first time since June 2021. We use it as a contrarian indicator when investors are under invested in the market, hence the cash level above 5%, we think that you should buy the market, and when it drops below 4%, we think you should sell the market. And at this stage, our FMS cash rule says that at this juncture, positioning is becoming a headwind. You also look at the cross-asset allocation. Equities allocation rose to net 31% overweight, and that's the largest one-month jump in equity exposure since November 2020. On the other hand, we saw a big decline in bond allocation. In fact, the largest one-month decline in bond allocation that we ever recorded. And the velocity of the rotation was also quite exceptional across markets. EM equities were the big winners with a 20-point rise in exposure to EM stock allocation. And that's really related to the China stimulus.
That's what I was going to ask. Was it really just the China stimulus that ignited this rotation, this unleashing of truly bullish spirits, or is it a combination of things?
It is definitely the China stimulus, but it's really the combination of three factors. Number one is that the conviction regarding global soft landing remains very much intact. 76% of FMS investors still believe the global economy will experience a soft landing. Note that the balance of risk has shifted to the upside because now the alternative scenario is no more hard landing, it's no landing. The second big reason, Lisa, is related to a big big Fed cut expectation. FMS investors expect roughly 160 bips of cuts from the Federal Reserve in the next 12 months. That's pretty much in line with market expectation. And lastly, of course, the China stimulus, which really is seen as a game changer, because when you and I met a month ago, China growth expectation had hit a 3-year low. Fast forward to today, they're now the highest they've been since April 23.
If you're one of those contrarians taking on the hard landing or no landing scenario, what does that mean for trades these individuals, these investors want to put on?
Yes, definitely. Who are the contrarians today? Those that would believe hard landing is their main scenario, and also those that would expect a no landing to happen in 2025. But if you are a hard landing believer, then definitely you should go long the 30-year treasury, you should pivot into defensives, you should pivot into cash, and you should really slash your allocation to equities and risk assets in general.
Elyas, I want to get your thoughts on what are investors, given how bullish they are, what are they nervous about?
We always ask in the FMS the main tail risk according to investors, and this month it was a geopolitical conflict. They are still a little bit worried about inflation, but definitely less worried about a US economic hard landing. So yes, geopolitical conflict. And I would say, on the other hand, what would really scare investors is that if central banks do not deliver the big easing that they are expecting. A month ago, we said that investors were nervous bulls. Now they have just become bulls that are leading the charge. And it would definitely still be about geopolitics and about inflation.
Elyas, you can see that bullish shift big time in the fund manager survey. Appreciate an update from you, as always, sir. Elyas Galou there of Bank of America Securities on the big bullish shift in the Bank of America Global Fund Manager Survey. This ain't bullish. It comes from Stellantis to halt production in some Italian plants in November. This has been an ongoing saga for production, particularly in Italy, where they'd already suspended production of the poorly selling electric Fiat 500 in Turin. I've got some stats for you for production in Italian plants over at Stellantis for the first 9 months of the year. Down 41% from last year. That's below the depths back in 2020. And if you pick out Turin, and anyone who knows Stellantis, particularly Fiat, that's the home of Fiat. Production there slumping 68% in the first 9 months of this year. So holding production after seeing numbers like that for the first 9 months of this year, hardly surprising.
Yeah, given the fact that there still is this overcapacity that they're trying to counter and a lot of cost cutting that they may have to do. This just highlights how we're talking about extreme bullishness, and yet there are pockets of weakness that are structural and cyclical, like the auto sector, which is a reason why a lot of people are looking specifically, even though they are pretty bulled up.
We'd already crunched the numbers here at Bloomberg. We're talking about a third of the plants of the big 5 automakers over in Europe producing at half capacity. How much longer can you keep on doing this? You can't just suspend production forever. At some point, you've got to make a decision about how many plants you actually need, how much capacity you require.
Which is the reason why a lot of urgency is being sounded by a lot of these executives who are coming out and saying we need some sort of framework in terms of how much support we're going to get from the government in order to kind of continue and figure out a plan that actually is viable for the longer term.
Stellantis down this morning by about 1.4%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shein is said to be adding more banks to help arrange a potential listing in London. Sources say Barclays and UBS have been picked as book runners for the online fashion retailer's IPO. Bloomberg has learned that the listing could happen as soon as early next year, valuing the company at $65 billion. Qualcomm is likely to wait until after the U.S. election before pursuing an offer to buy Intel. Sources say that Qualcomm wants greater clarity on what types of policies the next administration may bring on in antitrust and China relations. Qualcomm made a prelim approach to Intel on a possible takeover in September. Deliberations are still ongoing, and there's no guarantee that Qualcomm will decide to pursue an offer. And there's a new man for the top job in English football. Former Bayern Munich and Chelsea manager Thomas Tuchel will take the reins of the England national team starting in January. The announcement follows a months-long search after the departure of Gareth Southgate. The 51-year-old has won 11 major honors, including the 2021 Champions League with Chelsea and the Bundesliga title with Bayern in 2023. And that's your brief, John.
Danny, thank you. I don't like it, and I'll tell you why. I think in international football, everyone should be from the same country, don't you? England's done this a few times. Done it with a Italian manager before, Swedish manager as well. I just don't think it's the right approach to international football. Don't you want your manager of your team sort of singing the national anthem with you, hand across his chest and, you know?
Yeah, if they win, do you think people care that much? I mean, if they're really winning, you can get around it. Oh, he's one of us.
You've got to win, of course, yeah.
Learn the lyrics. It's great. So that's basically what I think.
Well, let's see if he can win. Up next on the programme, United Airlines taking off.
One of my takeaways, and in general the way I view the industry, is that they're very interdependent, right? So United's pulling a good quarter here, partly because other airlines cut back capacity as well as United.
The latest on the airline industry, up next. This just in from Oxford Economics. In the event of a Donald Trump victory, this is what they've got to say. The upside risk to the baseline GDP forecast during the next presidential term is twice as great as before, primarily because of the tax cuts the former president recently proposed. And as for the tax cuts, Lisa, there are many of them. There are many tax cuts.
I was about to say, which ones? Is it the tax cuts for tips? Is it the tax cuts if you have a house? Is it the tax cuts if you have a child? Is it the tax cuts if you breathe oxygen? I mean, it seems like which tax cuts you're talking about?
The Oprah Winfrey election. Everyone gets a tax cut across the board. That's what the former president is promising. But obviously, I think what Oxford Economics is talking about is 15% corporate tax. The issue is there's nuance to this. Donald Trump says you're only going to get a 15% corporate tax rate if your company is based in the United States, if your products are made in the United States. I have a lot of questions about what that means in terms of what if you have inputs from other countries around the world? What is the threshold for making something in the USA?
It's all Congress dependent as well, as you've said repeatedly too. Out of Savannah's this morning, United Airlines taking off.
One of my takeaways, and in general the way I view the industry, is that they're very interdependent, right? So United's pulling a good quarter here, partly because other airlines cut back capacity as well as United. And so as long as they're kind of following a similar script and following similar market signals, it'll work out. I think they're all benefiting from slightly lower fuel costs here, which allows them to lower prices without eating into profits, and that can stimulate demand.
So here's the latest. United Airlines authorising a $1.5 billion share buyback after reporting a beat on third quarter results, signalling the company is recovering from steep ticket discounts that squeezed many carriers through the summer. Stephen Trent of Citi, writing in light of the near-term interplay between airline supply and demand, the industry's capacity growth moderation is probably not finished. This moderation, continued positive demand and lower interest rates point to a good industry setup into 4Q. Stephen's with us around the table. Stephen, good morning. It's good to see you.
Thanks for having me back.
Let's just focus on the 4Q setup and the setup going into next year as well. From a capacity standpoint, how much has happened over the last few months? How much has been cut?
So you actually have had a lot of industry capacity coming out, primarily from the discount airlines. And when one looks at what's happened post-pandemic, there's been a big structural adjustment, a big wallet shift towards the network airlines, primarily Delta and United, and maybe one or two others. So when we think about the capacity coming out, some of the discount carriers should be flat or maybe even down in 4Q. So the setup actually looks very good for next year if you're on the network side.
Can you just explain why the beneficiaries are United and Delta? Why they're the best set up for what's about to take place ultimately over the next few months?
Yeah, absolutely. So on one level, if you look at what's happened post-pandemic, a lot of consumers are no longer 5 days a week in the office. So that has changed the way consumers behave, including the way consumers purchase tickets. A lot more blended travel now than there used to be. And at the same time that's occurred, we don't have the air traffic control capability. You have aerospace supply chain delays. We don't have the equipment. So given this dearth of new equipment per capita, on a long-term basis, when one thinks about how this is going to affect capacity and unit revenue, if you're a network airline, that's good news. You can put it in the price.
Yeah.
If you're a discount airline that is used to getting high volumes and high block hour utilization, that kind of no longer exists because we don't have...
Can I jump in? Blended travel. I can't let that go. Is blended travel people basically expensing vacations
Yes.
on a work's time? Is that what's happening?
I don't want to put it
I'll put it
that
another
way,
way. They're going on a work trip, paid for by their business, the company, and then they're turning it into a vacation on the back end.
Well, you go to a conference someplace Monday through Wednesday, Thursday through Friday, you have something else to do. You're already there, and you're not necessarily in the office 5 days a week. So it's at least conceivable that your employer or your customer is at least partially paying for that trip. And if that's the case, nobody wants a cheap seat. People want a nice seat.
All I could say is Eric Resnick of KSL, he called it bleisure. He said that actually they have a name for it right now, and bleisure is the hot thing that everybody's going to. So I'm sure, John, you'll be doing lots of bleisure, or else you'll be resentful that you're not doing it.
Yeah, well, I'm certainly resentful.
Yeah.
He's talking about
100%.
you skiing in Davos and me staying on in Puglia for the G7.
All right, moving on. I do want to ask, is United's gain potentially all of our pain? Basically, our ticket price is going up.
Yeah, look, so I do think over a long-term basis, the global aerospace supply chain issue is far from resolved. So are we going to have enough fleet, new equipment, as we had pre-pandemic, which allowed for a lot of cheap seating? I kind of think no. I think at least partially that, and possibly folks from lower socioeconomic strata travel less than they used to.
Are airlines just blaming potentially weak demand with the election, like other companies are saying, we're going to wait till we see the outcome of the U.S. election? Or will this actually show up in the data? People don't want to travel during a U.S. election period.
So we're hearing that this is actually already showing up in the booking curve. And I can actually say personally, I actually postponed an international trip because I wanted to be here. And I think a lot of people want to vote. And then they want to snuggle in front of their favorite cable news to see what the heck happens. So people don't want to be out of town for this, I would say. So, that does seem plausible to me.
Do you think that's just event risk that ultimately just clears? Regardless of who wins, we just get back to business? Or is it outcome dependent?
I don't think it's so much outcome dependent. I think regardless of who wins, and heaven knows how quickly we'll know who wins, I think people get back to business relatively quickly, and we get back to the pace of travel.
Get back to blended business. Stephen Trent at Citi. Love that. Love that. Won't let that go. Didn't know that was a thing. Is that what people are doing?
Yeah, Lisness or bleisure. There was
called?
We had a big
How
have I missed it?
Okay, honestly, yeah, you look at us. Yeah, we could have had discussions. We could have helped. I mean, you could just go for a couple days,
You
but otherwise,
on a day on a nice trip.
People do that here too, at this company.
They actually
shocking.
Yeah, all right, really?
Shocking.
Are you going to troll us all day? Is that what you're doing?
What if you started, Stephen?
The next report idea, I love it.
Yeah. Coming up on the programme, up next, the second hour of Bloomberg Surveillance. These two might not be here anymore. Keith Lerner of Truist, Charles Myers of Signum Global Advisors. They're going to blend the business this morning and turn this into a vacation. Gerard Cassidy of RBC is going to join us, and Gurpreet Garewal of Goldman Sachs on the outlook for fixed income. All of that and more up next.
It just continues to be a really supportive environment for nominal growth, and that is an environment that is particularly supportive for equities.
I don't think that there's anything that you would say, absolutely, I want to stay away from here.
The companies that have been leading the market are the strongest fundamentally.
The financials have done very well this year.
I think the banks are really going to send us off into a more positive 2025.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Lisa would like management to know that blended travel is better for the environment.
Yes, absolutely.
Combining work trips with vacations.
Yeah, you reduce emissions, so why not? I think that it's good.
I'm not going to argue with you.
Yeah,
second hour of Bloomberg Surveillance starts right now, and certainly not on that. Equity futures on the S&P 500 look like this. We're just about positive after snapping a two-day winning streak in yesterday's session. We'll get to the chip makers in just a moment. Your day ahead, the week ahead, looks a little something like this later this hour, 7:30 Eastern Time. Lisa, we round up and round out the numbers on Wall Street. We get Morgan Stanley.
And so far, the read across Wall Street has been very positive. We've seen beats across the board with net interest income. With Morgan Stanley, twofold. Number one, investment banking. We saw huge beats over at Goldman Sachs, in part because of the competition and working in tandem with private market companies. At the same time, it's really wealth management. How much are they capitalizing on that behemoth platform?
Morgan Stanley up 20% year to date. Goldman Sachs up by 35. Banks have been okay in the last 24 hours, with maybe the exception of Citigroup over the last week or so. The chip makers, a very, very different story. Check out ASML. Got absolutely hammered in yesterday's session. It's getting hit again this morning in Dutch trading. We're down by close to 4%. They came out with earnings yesterday on accident, and the numbers weren't good. Big downside surprise.
It came along with orders coming down about half of what people in the market had expected. A big question here. How much is this just a lack of demand for industrial and auto chips? We've seen that with Intel and others. How much is this because of their exposure to China, which is almost half of their sales, especially in light of some of the geopolitical tensions?
Well, it's supposed to be half of their sales, and the CFO comes on the call and basically says we see China normalizing, and that's going to be 20% next year. So this is when you look at some of the analyst calls, they're all looking to potentially China. Bernstein coming out and saying there's uncertainty. We have to look at clarification that China demand is expected to normalize. And how much more difficult does that China demand get, potentially, depending on what happens on November 5th?
This story took down Nvidia in yesterday's session as well. We were down by more than 4%. That's a $160 billion move on Nvidia. This morning, Lisa, up by, let's call it 0.6% in the pre-market.
I'm so glad you put it that way. $160 billion, and people just sort of shrug it off. Volatility, right? And we've really led to this level of incredible surges and plunges in some of the biggest names, trillion-dollar names. You just have to wonder how much that volatility could potentially spur a larger move. And we've been asking that question repeatedly. So far, it has not.
Trying to find just a little bit of stability this morning. Equity futures just about unchanged on the S&P 500. In the bond market, 4 weeks of yields climbing on a 10-year. This week, we're pulling back just a touch. We're down 2 basis points on the day, 4.01%. Coming up this hour, we'll catch up with Keith Lerner of Truist as chip makers weigh on global equity markets, Charles Maz of Signum Global Advisors as Trump defends tariffs on the campaign trail, and Gerard Cassidy of RBC with Morgan Stanley wrapping up earnings on Wall Street. We begin this hour with stocks looking for a firmer footing as earnings from ASML spook tech investors. The manufacturer of the world's most advanced chip maker machines booking only about half the orders analysts had expected and cutting its guidance for the year ahead. Joining us now to discuss is Keith Lerner of Truist. Keith, welcome to the programme, sir. This market was spooked yesterday by that one name and by those earnings. How spooked were you?
Well, first, great to be with you. I don't know that I'm spooked. I think, listen, it was a bad print as far as earnings. But, this market keeps changing narratives. You think about the broader market. One month we're growing too slow. We're heading to a recession for the U.S. Next month, we're growing too strong. And then with the chips, it's kind of similar, right? I mean, about 2 weeks ago, we were talking about Micron, talking about how much demand there was for memory and upgrading their forecast, and the stock's jumping. And then also context-wise, NVIDIA, since early September, that kind of after that sell-off, was up over 30%. Semiconductors up over 20%. And then you have this print, and we all know now that ASML's biggest customer is China. So, listen, I don't want to be complacent about it, but I'm also trying to put it in context. And I think longer term, especially on the AI side, there's still a lot of demand. Don't forget, maybe one more comment is that, a couple of weeks ago, we were all talking about Elon Musk and Larry Ellison fighting over NVIDIA chips. So, again, just some context.
Keith, you're right.
In order.
NVIDIA themselves have talked about massive demand, and I think you're right to identify China, because speaking to that is LVMH. LVMH earnings, big downside surprise there. Sales not great, particularly in China. So, Keith, as people start to get excited about investing in the rest of the world, when you think about where your bias is, and I'm going through some of the details of your positioning, overweight stocks, underweight cash, and you maintain a bias to large caps. Are those large caps in America?
Yes. I mean, we've been Team USA, talked about this on this program for several years now, Jonathan, so we're still there. I will say on the margin, we're still, emerging markets, we moved out of emerging markets completely over the last couple of years, and that's been the right move. Emerging markets have underperformed by about 50%. We upgraded emerging markets one notch here recently, still not overweight. But I will say, I mean, if you look at the rhetoric out of China, I think that they're going to still continue to support that stock market. It got overheated. They don't want it that overheated. So you went up 50%. Now you're down about 15%. I think we're going to get more news, and I think that they will support their market. So on the margin, I think a little bit better. But again, bigger picture, we are still Team USA. I'm just making a reference to a subtle change.
Keith, we were talking earlier about the Bank of America Fund Manager Survey and the three pillars that were really supporting the incredible bullishness that has seeped into the market for the past few weeks. One of those prongs was the China stimulus, and yet there's a really concrete question here about how much any kind of stimulus will even trickle into the global market versus just stay in China. How much can that be a pillar of optimism for U.S. stocks?
Well, we didn't need, we haven't needed the growth there for the U.S. markets to be in this great bull market. So I think this recent stimulus is a defense move by the government. But I do think it is the most massive stimulus we've seen since, the pandemic. And I will say, I think people are looking for shifts already. Like the stimulus acts with a lag mostly. So I don't think you're going to see it overnight. And I don't think there's going to be this big global stimulus that's going to help Europe to the same extent. I think it's much more focused on stabilizing the local economy, helping the local stock market as well. So I think when people think about the stimulus, I don't think it's the stimulus that we've been accustomed to over the last 2 decades for China and the way that seeps into the rest of the globe.
In the meantime, Keith, we were talking about some of the swings that we've seen overnight, not just in ASML, but also in NVIDIA. And the fact that you're seeing a $160 billion move on any given day, not necessarily on anything related to that specific business, gives a sense of how jumpy and volatile specific names have been. How do you play that, especially if you have a bullish take on it? At what point does it become concerning? At what point is it a buying opportunity for you?
Yeah, so speaking specifically to tech, I mean, we were overweight tech most of the year. We downgraded in June after it got extended, and then in August, during the pullback, we added back to it. I would say so. We're still positive on tech. We still don't think we're in an AI bubble. And then with semiconductors specifically, like I said, they had a big move in a short period of time. So we're staying with that primary trend, which we think is up as long as the earnings continue to support, meaning we focus a lot on the forward earning estimates for the broader sector and also the industry. So far, they are still stronger than the overall market. Where we would change our tune is if we see that roll over. We haven't seen it at this point, and I don't think ASML is enough to change it. But again, we'll keep an open mind as we head deep into this earnings season.
This bullishness just hit a bit of a wall in the last 24 hours. And I have to say, I've identified a lot of bullishness just around the table from some of the guests we've been speaking to, Lisa. You hear it from Jonathan Galou over at UBS. It's a move to the upside in terms of their outlook, their price targets. This is from the Bank of America Fund Manager Survey. We were sharing it just yesterday on this programme. The biggest jump in investor optimism since June 2020 on Fed cuts. The biggest jump in global growth expectations since May 2020. The biggest jump in global equity allocation since June 2020. Keith, this came from Jonathan Krinsky over at BTIG. Fear of downside has left the building, and fear of missing upside is front and centre. Yet we think now is the time to look tactically at downside risk into month end. Keith, I know it's a very short time horizon, but going into the end of the month and particularly into November, how are you thinking about how to position?
Yeah, so I think time frames really do matter. Like most of our clients aren't trading for the next 2 weeks, but I will say I agree that sentiment is a bit of a risk here short term because markets are all about how things come in relative to expectations. Those expectations have increased. You're also seeing that in the put to call ratios, which are at the lowest levels since July. I will mention that Global Fund Survey, June of 2020 ultimately wasn't such a bad time to invest. On a short-term basis, you had a 4 or 5% pullback around that period. But again, remember, that was the early stages of a bull market. I'm not saying we're the early stage of this bull market. So I think the way I would think about it is on a short-term basis, maybe a little bit extended, maybe you get at least 1 or 2 more hiccups around the election. But I would think that would be contained within that 5, maybe to 10% max side, and keep focus on the underlying trend, which is positive. I'll also say in an election year, by the way, this is the strongest election year we've seen for the stock market since the 1950s. Normally, if you've been up more than 10% heading into the fourth quarter, you've been up every time. Small sample was only 7 times, so I just want to be clear. So I would just say stick with the primary trend, and we get some hiccups along the way. I would use that as an opportunity to add.
How much, Keith, does the gain of stocks come on the pain of bonds at a time where there's sort of an inflationary question mark underpinning a lot of this, whether we're in a structurally higher inflation kind of regime? How much are you betting on that in terms of the allocation of stocks really is because bonds look less appealing to you?
Well, bonds have actually acted pretty well this year. They've been acting more like a diversifier. I think for the stock market to do well, is really bonds could be stable because of what we've seen recently is, our work suggested that, fair values are right around where we are in the 10-year Treasury right now. So I think there's still some value in bonds from a diversification standpoint. There's still decent income there. But, where we would get more concerned is if we started seeing yields move back up, say above 450, credit spreads start moving out as well. That would be the concern. But where they are today, I don't think is a major problem. And I still say we still see relative value in the equity market, just because if the economy stays more resilient, that should lead to corporate profits continue to move up. And that's been the most stable thing we've seen in this market, right? All the narratives have shifted. The earning trends for corporate America have been the most stable part of this market.
Keith, I have to say, there has been a lot of bullishness around this table, and it has been growing over the past few weeks. This from Barry Bannister, just to give a dose of cold water and some contrarian thought over at Stifel, basically saying that the S&P could gain another 10% this year, but then will plunge by some 40% by next year, just simply because, as he said, there is a cost to so much winning that basically when you take a look at valuations, they're starting to look pretty heady. At what point do you get concerned just about valuations in and of themselves?
Yeah, listen, I think Barry's a tremendous analyst. I respect his work. We're not in that camp, to be frank. I mean, when we look at, like, say, 10-year rolling returns or 5-year rolling returns, not extreme, maybe more on a short term, somewhat extreme. Valuations are a tough thing, right? Because, valuations have changed over time because the tech sector is now, 30% of the market. If you look back to 1990, the S&P tech sector was about 6%, right? And that's where the valuations have really expanded. On the same token, that's where the cash flow and that's where the profit margins are. So in our view, as long as the economy continues to move forward, corporate profits move forward, we can sustain somewhat of higher valuations. I think the way to think about valuations is it likely caps the upside. And in some of our long-term work, we actually think long-term returns are actually below average. On a short-term basis, I think it's really difficult to use valuation to say where the market's going to be, at least in the short term, as far as the next 6 to 12 months.
Keith, would love a final word just on the banks, on the financials going into Morgan Stanley in about 20 minutes' time. What's your take on the earnings season so far? Is this a place you still want to be?
Yeah, you're going to make me look bad in front of a Morgan Stanley print in 20 minutes. I'm just joking. I like the financials. I think the economy is still relatively resilient. Credit seems like it's doing pretty well. They just broke out from a technical level. So we actually like financials along with technology and utilities as our current overweights.
Keith, appreciate it. Keith Lerner of Truist. I've got no knowledge of what those numbers look like, so you may or may not look bad in 15 minutes' time. Keith, thank you. Those numbers are just around the corner. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Vice President Kamala Harris is leading in political donations, but former President Donald Trump has picked up some big-name support. Elon Musk has poured $75 million into the super PAC he created earlier this year. Billionaire Miriam Adelson, meanwhile, added $95 million to her super PAC supporting Trump. And venture capitalist Mark Andreessen and Ben Horowitz each donated $2.5 million to a pro-Donald Trump super PAC. All of that according to the latest filings with the Federal Election Commission. Qualcomm is likely to wait until after the U.S. election before pursuing an offer to buy Intel. Sources say that Qualcomm wants greater clarity on what type of policies the next administration may bring on in terms of antitrust and China relations. Qualcomm made a prelim approach to Intel on a possible takeover in September. Deliberations are ongoing, and there's no guarantee Qualcomm will decide to pursue an offer. The NFL and Jay-Z are extending their partnership. NFL Commissioner Roger Goodell said that the league will continue to work with Jay-Z's Rock Nation Entertainment Company to produce the Super Bowl halftime show. A release said that Rock Nation and the NFL struck a deal in 2019 to, quote, spearhead and advise on the selection of artists for the NFL's tentpole performances. Rock Nation also helps the league with its Inspire Challenge program, the league's social justice initiative that has given out $375 million in grants. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, an economic media blitz.
Black families are 40% less likely to be homeowners than others. And that home ownership is one of the surest ways to build intergenerational wealth.
More on that conversation up next on the program, live from New York City. Good morning. Live from New York City, welcome to the program. Equities right now on the S&P 500 firmer by almost 0.1%. Under surveillance this morning, an economic media blitz.
To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm to help it. But to me, it's the most beautiful word. We're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before. And we're going to protect them when they come in because we're not going to have somebody undercut them.
So here's the latest. Former President Donald Trump defending tariffs on the campaign trail. Meanwhile, Vice President Kamala Harris ramping up outreach to black male voters.
My agenda is about tapping into the ambitions and the aspirations, knowing that folks want to have an opportunity. If they want, they should have a meaningful opportunity to build wealth, including intergenerational wealth. Black families are 40% less likely to be homeowners than others. And that home ownership is one of the surest ways to build intergenerational wealth.
Tonight, Harris sitting down for her first formal interview with Fox News. Bloomberg's Katie Lyons joins us now for more. Katie, let's talk about that key demographic for Democrats. What can she do to regain some of the support that they've lost, not just over the last 4 years, but over the last few decades, to be honest, going all the way back to Barack Obama?
It's an excellent question, John, and you're seeing it borne out in the data that this is a problem area for Democrats. Yes, Kamala Harris now, according to the New York Times and Siena College, has the support of roughly 8 in 10 black voters, up from the 74% Joe Biden had when he left the race. In 2020, Joe Biden got 90% of that vote. So there is still a big gap here in terms of what the turnout for a Democrat, or at least the sentiment around a Democrat, was 4 years ago than to what it is right now. And black men are a big part of that, as we have seen more successful outreach done by the Republican Party toward that key demographic. I was speaking just last week with Quinton James, who runs the Collective PAC. It's a PAC focused on electing black leaders to office and turning out the black vote, who said, look, this is an economic problem at the end of the day. Black men want to be told how the economy will become better for them. So that is kind of how you're seeing Harris really target her course correction here. It is around issues of the economy. She, in that show on Charlemagne the God yesterday, which we just heard a bit of, talked about how reparations that could be paid to black people need to be studied. She also, of course, has put out other policy proposals around small business loans for $1 million loans with forgivable up to $20,000. Also, crypto deregulation and federalizing marijuana, legalizing marijuana on the federal level. Rather, all components of this reach out that she is doing to this very key group.
We also see her tonight with Bret Baier. So clearly she's also going after those potentially more moderate around the country or leaning tactically to the right. How much is the gender gap also impacting the decisions both Kamala Harris and Donald Trump are making in terms of what interviews they decide to do and who they decide to go sit down with?
Yeah, the gender gap is really wide in this election. Women far more likely to be supportive of Harris and men more likely to be supportive of Donald Trump. So you see that in the media strategies, frankly, of both candidates that we have seen in the last few weeks, including Kamala Harris's interview, not just with Charlemagne yesterday, but Howard Stern's show last week, also trying to expand her outreach to men. And for Donald Trump, he did an all-women town hall that taped yesterday in Georgia with Fox. It will air fully at 11 a.m. Eastern time, in which he did have to field questions around reproductive rights, talking about how he sees some states as being too tough on their abortion restrictions. And he thinks in some of those states, those restrictions will need to be, quote, redone. And that is part of a softening in the stance around reproductive rights we have seen from the Republican ticket as a whole, not just Donald Trump, but also his running mate, J.D. Vance, who on the debate stage earlier this month said that Republicans need to gain back trust on that issue in particular. And of course, it was during that debate that Donald Trump posted on Truth Social to say he would veto a federal abortion ban. So that's really how he's trying to pull more women back into his corner.
Is there any justification yet, data that shows that that's working, this more nuanced, potentially moderated tone the former president is taking when it comes to reproductive rights?
Voters are still overwhelmingly to say that it is Harris they trust more with reproductive rights in particular, and they're far more likely to say they trust Donald Trump on the issues of the economy and immigration. Those haven't budged much, although we are seeing some movement on the margin. Certainly on the economy, we have seen Harris gaining material ground from where Joe Biden was. And in some more specific issues than just the economy overall, like helping the middle class, she has actually been able to outpace Donald Trump, including in our own polling. with Bloomberg and Morning Consult. That said, when you look at polling as a whole, not just on the issues, but about where this race stands, we have seen a material tightening in recent weeks, including on national level polling, which basically shows that this is still a neck and neck race, as we knew it would be, but we are well within the margin of error here, and it's getting very, very close in the key states that ultimately could decide this thing.
Kayleigh, we've talked about this extensively. I don't feel like I've got a clear answer on this. We've seen a real momentum shift when we take a look at prediction markets. And certainly, as you mentioned, there is a tightening in the polls. Can you point to anything in particular? Is there a particular issue or a particular region that seems to be leading that?
I don't know that there's a particular issue necessarily, Lisa, but something I've been discussing with strategists, frankly, on both sides of the aisle in recent days is that there haven't been many clear catalysts. If we consider just Kamala Harris's campaign specifically, which of course launched something like a rocket ship, frankly, once Joe Biden left the race in terms of fundraising, in terms of how immediately she was able to jump where Joe Biden was at the polls. She had her candidacy launch, followed shortly thereafter by the selection of her vice president. Shortly thereafter that, of course, the Democratic National Convention in Chicago. After that, a debate against Donald Trump. That was back in September. Since then, there hasn't been any kind of big catalyzing event like that. So that could be a factor here, certainly, as we are not likely to see another debate between these two candidates. And so they're forced to grab their own media attention, if you will. And that's why we're seeing them picking up the pace of interviews on a variety of different platforms and mediums in recent weeks.
You mentioned with Donald Trump a real question around reproductive rights and his appeal to women. What specific issues are you looking to hear from Kamala Harris in her interview tonight on Fox?
Well, I'm sure she's going to be pressed on her weaknesses, which, as I mentioned, are immigration and the border. She could face questions around what we have seen consistently from Republicans. Why have these issues not been fixed as she's been vice president for the last almost 4 years? It's going to be interesting to see how she tries to center herself in this interview, operating under the understanding that she's appearing on Fox for a reason, as she's trying to reach out to, say, those Nikki Haley voters, people like Liz Cheney, who do identify as Republicans but do not want to support Donald Trump in this election. So in many of these ideas, she's going to have to moderate herself. Those are the kinds of difficulties she's going to face in this questioning, as she has not appeared on Fox yet in this election cycle. And of course, this is an audience that is not as friendly to her as some of the other networks on which she has appeared of late.
Kayleigh, appreciate the update. As always, Kayleigh Lyons there. Down in the nation's capital in Washington, D.C., as Kamala Harris, the vice president, tries to do something about the black male vote, which has been weakening ever since 2008. You have to go back several election cycles, which makes the comments from the former President Barack Obama even more odd last week, to lean into the issue, to make it sound like the bigger problem here was the prospect of misogyny, that individuals didn't want to vote for Kamala Harris because, quite simply, she's a woman. I'm sure you can find examples of that. But overwhelmingly, if you go back several election cycles, the biggest pushback to that by some measures, Hillary Clinton got more of that vote than Joe Biden did.
It's unfair to blame it on Kamala Harris being a woman, because actually it's the Democratic Party losing black men ages 18 to 45 since 2008.
It's a problem, and it's been a problem that's building for a while for that party. Coming up on this program, Gerard Cassidy of RBC, results from Morgan Stanley. Coming up next, that stock is up 1%. Live from New York City, welcome to the program. Equity futures on the S&P 500 just a little bit higher. On the S&P right now, up by about 1/10%. On the Nasdaq, up by 0.2. One name in focus, Morgan Stanley. Morgan Stanley up in a pre-market by 3%. I'll make it simple. One word: beat. A few more words: beat, beat, beat. This is what it looks like. Third quarter wealth management revenue, $7.27 billion. The estimate, 6.88. Equity trading, beat. Fixed sales and trading, beat. Investment banking, beat. Going to make it easy, Shanali. Where did they miss over at Morgan Stanley?
You have to look through the finer tooth details. There's only a little bit of a miss there in the equities underwriting, but they can get a big pass here, because not only is it a clean read, it's a soaring read. And this is an environment that's a real sweet spot for Morgan Stanley. Wealth management revenues coming in not only above expectations, but those pre-tax margins handily beating. That is something the street watches very closely. You also have equities trading coming in well above expectations, fixed income trading as well. Equities now is interesting because even though the number beat beat expectations. It came in a little lighter than Goldman Sachs. That competition has been really stunning to watch on Wall Street, and will be interesting to see what the CEO says about how competitive they want to get, because it's a matter of how much risk they want to take on in these markets at record highs. Very little to look down on here. The expense efficiency ratio is better than expected and better than it was a year ago. So they're making more by keeping a handle on costs as well.
Yeah, well, they're talking about having more assets under management, more revenues from wealth management as well. One interesting theme that we've seen from all the banks, and this is the final of all of the big ones to report, is an increase in provisions for credit losses that's being viewed as a bullish thing, that they actually want to take on more risk, not as a bearish thing that they're anticipating an increasing number of delinquencies and defaults. Can you explain that?
Yeah, it means that people want to be extending credit here at this part of the cycle. And you can see it not just for the consumer, but for the corporate clients here, for all the big banks. Debt underwriting, just stunning at every one of these banks. But I also have to say, you have to wonder if that sentiment about not worrying about provisions will last through the regional banking cycle as well, because these clients tend to be wealthier. We talk about those FICO scores at Bank of America. Even at Citigroup, they're generally above 660. So once you start to get into kind of the players that are in the riskier parts of the market, that's when the sentiment starts to be questioned a little more.
I will just say PNC and U.S. Bancorp both have reported earnings and both beat expectations as well across the board. So some of the lower tier or smaller banks, those are the top tier of the smaller banks, have also beat estimates. When you take a step back, can we still say that Morgan Stanley and Goldman Sachs truly are neck and neck in the way that they used to be? Or are they different banks with different profiles that have different goals at this point in the cycle?
I think the market is telling you they're different banks. And the reason why is, if you can imagine, before we headed into these earnings, Morgan Stanley this morning was actually trading at a higher price to book than JP Morgan. What is going on there? People really, really love Morgan Stanley at this part of the cycle. And I think it's because you saw about a year ago, they finished integrating the rest of their wealth businesses. They headed down towards the stack when you think about the wealthy clients they've taken on, and more mass affluent as well. What can they do? What I'm understanding about Morgan Stanley is they're trying to lean into that wealth management business to also drive more investment banking revenue. Now, if they can catch up to a greater degree to Goldman Sachs to that investment banking revenue, game on.
Stock is up by almost 3% this morning after rallying 20% through yesterday. You're catching up with Ted Pick a little bit later. Is he putting his stamp on this company now, on this bank? Is he getting out of the shadow of James Gorman?
It took a couple months, but that's kind of nothing, isn't it, after James Gorman's legacy? And you do see these numbers coming in super strong. It's no surprise that he wants to talk today, right? And so, some questions I have are around how sustainable this is. These are really good numbers. And at the end of the day, we are looking at hedge funds sitting at near record leverage. Can they keep doing that to drive this market higher?
Looking forward to this conversation a little bit later, 10:30 Eastern Time. Sonali Basak sitting down with Morgan Stanley's Ted Pick. Joining us now, Gerard Cassidy of RBC. Gerard, that wraps up the earnings on Wall Street. Let's sit on Morgan Stanley just for a few beats. A number of beats from that name, a few upside surprises. Gerard, what do you make of what's behind these gains from the likes of Morgan Stanley, from Goldman? Are they durable? Do you expect these tailwinds to stay with these companies into 2025?
I think so, John, because when you take a look at some of the lines for these companies, in particular the ECM business as well as the advisory business, as David Solomon from Goldman Sachs yesterday pointed out, that we are still below the 10-year averages, and so particularly in IPOs. So if the Fed is truly going to continue to ease and cut rates between now and the end of next year, we're in the soft landing, as I think you guys know. This sets up very well for the investment banking business, especially, again, on the IPO business and possibly in the mergers and acquisitions. Higher rates had really kind of put a little cold towel on that, as well as regulatory concerns out of Washington, but lower rates should help the mergers and acquisition market in 2025.
Gerard, what do you make of the increase in revenue that we see from trading as well as banking at a time where a lot of people said that is an area that needs to reignite? You were talking about the regulatory regime, in particular, some of the dampened IPO activity. How can we understand then the incredible beats that we've seen across the board?
I think part of it is that when you take a look at the trend lines, from 2020 and 2021 have been generally lower, as you know, particularly in 2023, and things are starting to come back. And on top of that, the amount of liquidity in the markets is phenomenal. And when you think back to what the Federal Reserve did during the pandemic, they took their balance sheet to $9 trillion. They've brought it down now to just over $7 trillion, but that's well above where we were pre-pandemic, around $3 to $4 trillion. So there's plenty of liquidity out there. Asset values are going up. And as a result, you're seeing it in the trading numbers, both in fixed income and equities. The investment banks pointed out that after the Fed funds rate cut, they really sort of pick up in DCM activity, which then led to probably better FIC activity as well.
You know, I have to say, Gerard, Chanel mentioned this point earlier. This is the big banks, but not necessarily the smaller regional banks. And I do wonder how much we're also seeing the outperformance in smaller banks, in regionals. Gerard, from your perspective, are you seeing better than expected performance, the likes of PNC and U.S. banks, as really highlighting what a different scenario we're in right now?
We did see better than expected numbers there for both those banks, as you pointed out, and you were going to see a slew of regional bank reports over the next 2 or 3 days and into next week. And we do expect to see a continued better than expected performance. And the real key is going to come as the Fed continues to lower short-term interest rates. As you know, funding costs are going to come down. Funding costs went up meaningfully as rates went from 0 to 25 basis points to over 500 basis points from the beginning of 22 through the middle of 23. Now, asset yields will come down, as you know, but they're not going to come down, we don't believe, as fast as funding costs. So the regional banks, which rely on net interest income to a greater extent than the diversified banks, should do quite well in this environment over the next 12 months.
Gerard, shouldn't that also benefit Bank of America? And I'm going to raise a very dangerous question because I don't know the answer to this, and I imagine you don't either. What's Warren Buffett actually up to, selling down a stock into an environment that the stock should do well in?
John, it's an interesting comment because, you know, Buffett has made an enormous amount of money when you think about when he put that first investment in, I think it was back in 2011. So when you think about how much he has made from that period to where we are today, if you look out over the next 2 to 3 years, will he make that kind of return? Probably not, because he got in at such a low cost basis back in 2011. So I just wonder if it's good old fashioned profit taking. Obviously, we don't have a call into him. They don't disclose why they sell stocks, but you have to wonder if that's that's the reason for the sales.
Yesterday, we heard CEOs talk about strength when it comes to the U.S. banks. Today, Ted Pick, in his message to shareholders, the first adjective he's using is strong. Was there any weakness that you're seeing in any of these big banks?
I would say the short answer is no. There is still the concern of commercial real estate office, so we should not overlook that. Now, when you think about that area in particular, from the end of the pandemic to today, the deterioration has been meaningful and noticeable. The good news is that the urban office markets are not, the banks don't have overexposure there, particularly the smaller regional banks. So we're not out of the woods in that area. So that would be the one area that we would continue to monitor and watch. The banks have taken their medicine. Many of them have reserves to those office commercial real estate portfolios that exceed 10% in credit losses, which is very meaningful. But that would be the area we're in the early innings of working that problem out. It'll last probably another at least 2 to 3 years. But again, we think it's very manageable.
Gerard, I have to say there's always a spectrum when you listen to bank earnings of fear as well as greed. And right now, with the increase in credit provisions, you have to think at this moment, based on some of the commentary around that credit provision build, this is more, I don't want to say greed, but more the desire for bigger returns, more the desire to lend. How much is this a signal that credit is actually going to loosen up dramatically? That in terms of easy financial conditions that people describe in capital markets, that's going to trickle into consumer loans and a whole host of other types of lending activities?
Lisa, I think you're onto something, because two things have happened. First, if you look at the senior loan officer survey, back in 2022, when rates were moving up very rapidly, everybody was expecting recession in 2023, and the banks tightened up their lending standards. They built up their loan loss reserves in anticipation of a recession, which obviously never showed up. But also, you might remember Basel III Endgame. That proposal came out in July of 23. That was going to require banks to carry much more capital. You might remember the expression risk-weighted asset diets that even JP Morgan talked about last year in the second half of 23. So now with the new Basel III endgame that hopefully we'll get the numbers by the end of this year, the expectation is a much lower capital increase. So the banks have plenty of room to lend. They see the economy looking better. So I think the surprise next year, to your point, is that we could see better lending, particularly in commercial and industrial lending, as companies start to build out inventories, take on capital expenditures, and the commercial banks will be beneficiaries of this.
Interesting. Gerard, appreciate your contribution, as always, sir, to earnings season. Gerard Cassidy there of RBC. On the big banks on Wall Street, as Morgan Stanley rounds things out, that stock is up in the pre-market by 1.6%. Let's squeeze in a few more news stories. Under surveillance this morning, the US has a new warning for Israel. The Biden administration saying it may withhold weapons to the country if the humanitarian situation in Gaza does not improve. A letter to Israel's defense minister calling for a minimum of 350 trucks of aid into the Gaza Strip per day.
What's interesting about this is, one, we heard from one Pentagon spokesperson who said we didn't mean for this letter to get out. So clearly they didn't want the world to know about what was going on in terms of basically this idea that potentially what they're insinuating is they may withhold some weapons if Israel doesn't get that aid through. Also, they said they have 30 days. That brings us to after the U.S. election. My view on what this Biden administration has been doing in terms of how they have this almost carrot and stick approach when it comes to Israel and potentially other foreign policy issues is it feels like they're just treading water to get over November 5th.
Which really is the reason why, and actually we've been discussing this in this show, this question of how perilous the next couple of months will be from a geopolitical standpoint, because there is this perceived vacuum of leadership in between the election and whoever takes office in January.
We still really don't know how Israel's going to respond to what has been an unprecedented attack from Iran. Not too long ago, these were red lines that if Iran crossed, this was a big, big deal. It's still a big deal. We're waiting for retaliation.
What this past year has told me is that constantly red lines have evaporated in front of our eyes. Not just one Iranian attack on Israel, a bombardment of missiles, but two. April, most recently, a few weeks ago, also the THAAD being sent over to Israel. That has never happened before. So we are really in almost a whole new fragmented geopolitical world just in the Middle East itself.
That region has changed a lot in the last 12 months. That's the latest from the Middle East. Here's the latest in the airline business. United Airlines beating Wall Street's profit expectations for the third quarter. The company also authorizing a new $1.5 billion share buyback. More airline earnings ahead this month, including American, Southwest and JetBlue. We caught up with Citi earlier this morning. Some of these airlines, not these airlines, have reduced a lot of capacity. And these airlines are going to be the ones that ultimately win out because of it.
And essentially, to me, basically, read between the lines, prices are going up again. I mean, essentially, airplane prices are going to go up for people who can afford to fly, and those who can't probably aren't going to fly. And that's why you're going to see the lower income airlines not do so well, because essentially what you've heard from all these airlines is that the glut and the pressures from competition have been alleviated, which basically means expect to pay more.
I thought it was just an excuse that airlines were saying they're going to lose some demand because of the U.S. presidential election. People want to stay home. But Citi's saying actually they see it in the booking curve. And even our Citi analyst is telling us, I'm foregoing an international trip because I want to be in the United States to vote and snuggle up to his term, watching the news and the press.
Less blended vacations, apparently. Blended trips.
Yeah.
Work, vacation.
Leisure. What is your aversion to it?
Okay.
Honestly.
I just wasn't aware that it was a thing.
Oh,
and then you both told me that you've been doing it for so long and I didn't know.
Oh, really? Keep going with this. This is great.
I didn't know about this. Let's talk about chips. You want to talk about chips? We should talk about chips.
Chips or trips?
Chips. Chips and trips. Global chip stocks under pressure. A tepid outlook from the key equipment supplier ASML, sparking a sector-wide rout as the company cut its outlook on areas beyond AI. Market jitters extended to Nvidia shares. They fell nearly 5% on Tuesday after reaching a record close just earlier this week. Lisa, I think you break it down really well. There's something happening beyond AI that may not touch the likes of Nvidia. It might impact other companies. And then you've got this big piece of the puzzle. It's China. And LVMH spoke to the weakness in China.
And it's very difficult for people to really parse through this. We've seen this with Intel, right? I mean, they are more exposed to the industrial and automotive sectors that buy chips, and you haven't seen a real revival in that sector. On the flip side, If you have a company with such a dominant market share coming from China, how much are they going to be permanently and structurally challenged as a result of some of the fissures geopolitically between China's tech world and, frankly, everything else and the rest of the world?
ASML, the main listing over in Amsterdam, the Netherlands, that stock is down, recovering just a little bit, still lower by 2.9%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Airbus plans to cut as many as 2,500 jobs at its defense and space division. Sources tell Bloomberg the plane maker is attempting to streamline a business that's been racking up charges and suffering from competition. The people familiar say that Airbus is still evaluating options on just how to downsize that business and is in discussions with the unions about those job cuts. Adidas has raised its profit target for the third consecutive quarter thanks to a boom in demand for its retro sneakers. It now expects operating profits of $1.3 billion. But as you can see, shares of Adidas are lower in the German trade by about 3%. Investors expected the company to raise guidance after its recent outperformance, especially when compared with its rival Nike. Shares, though, are up nearly 27% year to date. Tom Brady has been approved by the NFL to buy a stake in the Las Vegas Raiders. Brady, along with Knighthead Capital Management co-founder Tom Wagner, are buying a 10% stake in the team. The former star quarterback is the only broadcaster who is a part owner of an NFL club. The league, though, placed strict restrictions on Brady. He isn't permitted to attend in-person or online production meetings. He can't have access to team facilities, places, or coaches. He also can't criticize officials or other clubs. And that's your brief. John.
Apart from that, he can do what he wants. What's that about?
Yeah, I don't know. It's just basically a money thing rather than an influence thing, I guess. Sounds boring.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, staying vigilant.
We have to be really focused on fully delivering on 2% inflation while ensuring that the labor market remains in line with full employment.
That conversation up next. No drama this morning. Check out the board. Not much of anything. Equities going nowhere on the S&P. FX pretty much unchanged. Bit of a bid in the bond market. Yields coming lower. It's been a theme over the last few days, encouraged by that move in crude over the last few days as well. The 10-year just about holding on to 4%. Under surveillance this morning, staying vigilant.
Continued progress towards our goals is not guaranteed. So we must stay vigilant and intentional. What does that look like? Well, it means continually assessing the economy and balancing both of our mandated objectives. We have to be really focused on fully delivering on 2% inflation while ensuring that the labor market remains in line with full employment.
So here's the latest. San Francisco Fed President Mary Daly speaking to Bramo, looking to insulate the labour market. Investors looking ahead to tomorrow's retail sales and jobless claims data for more clues about the Fed's path forward. Goldman Sachs Asset Management writing in their Q4 fixed income outlook, quote, while the likelihood of a no landing, namely persistent inflation requiring continued monetary tightening, has decreased, a soft-ish landing has emerged as a new plausible scenario. Gurpreet Garewal of Goldman Sachs joins us now for more. Gurpreet, we've got to go there. Explain the difference between hard, soft and soft-ish. What is soft-ish?
Hi, Jonathan. First of all, great to be with you. First of all, I would say that these scenarios are highly stylized. There's much more nuance and complex in the economy. But one of the things that we did in our quarterly outlook is to analyze what are the potential scenarios, what's our central scenario, and what are the tail risks around that. And I think relative to, the third quarter when we were doing the same exercise, the prospect of a no landing where you still have firm inflation requiring central banks to continue hiking has clearly abated. We've gone from talking about easing cycles to now being in one. That puts fixed income front and center for investors. And then when we think about the other scenarios, things do seem like a soft landing when you look at some of the data today. Jobs data has been strong recently. The labor market is firm. Consumers are still spending. Financial balance sheets still looking good, good shape and good health. But there are uncertainties around the labour market. There's political uncertainties, geopolitical uncertainty. And so the key way to distinguish between those is a soft landing would entail growth around slightly above trend and a healthy labour market. A softish landing is moderate weakness in the labour market and growth slightly below target, but not necessarily recessionary. And you have more bumps in the data, more bumps in the road. We've seen that with inflation data this month, but we've seen it in the past with the jobs data.
Gurpreet, this might be a dumb question, so forgive me, but why has the possibility of a reignition of inflation, of a reignition of growth, a positive upside surprise that's more of a no landing that challenges the Fed to potentially adjust interest rates higher, why is that off the table?
I would say, first of all, there's no such thing as a dumb question. That's not off the table. I think the scenario that we still have in our outlook and what we discuss is a plausible re-acceleration in the economy. And that could be a function of the fact that the Fed is clearly looking to sponsor an ongoing expansion. You have pro-growth policies coming out of China. Easing into the world's largest economies is supportive of a potential re-acceleration. You could get rate relief in sectors like housing. That could revive employment, revive growth. I think the key area where we maybe sort of differ is the potential inflationary risks. Relative to the pandemic shock and the energy shock of recent years, inflation pressures have become less broad-based. Inflation expectations are back in check. When we look at our underlying inflation indicator, which tries to strip out a lot of the noise, things are still looking like they're on track towards disinflation. And we think even in that scenario, you could still see central banks dialing back from restrictive towards neutral, and fixed income could still benefit in that environment. Now, of course, we are always attentive to potential upside risks. So it's not eliminated completely. It's just we think the potential scenarios are acceleration and hard landing as the tail risks, and soft or softish landing as sort of the core scenario.
Gurpreet, I'm also struck by the differentials right now, especially ahead of tomorrow's ECB meeting. How much are we looking at an ECB that could potentially lower rates much more than people expect, and a Fed that might have a higher floor for how low they can cut rates?
That's an excellent point. One of the things that we do emphasize in our outlook is that you're seeing more macro divergence. We do anticipate that the ECB is going to deliver a 25 basis points rate cut tomorrow. That would be the third in its cycle. And we do think that they are going to be on a path of consecutive cuts because you are seeing more evidence of slowing in the economy. We have a current activity indicator which tries to give us a more timely read on growth than GDP data. That stands at 3% today for the US. That's in line with the annualized growth that we saw in the second quarter, but it stands at 0.7% in the euro area, so clearer deceleration in growth. And what we saw in Europe, already this summer, that there was divergence. Southern European countries were boosted by tourism, sporting events, Swiftonomics, that effect, whereas you still see an ongoing weakness in Germany. And I think things are looking much more weaker in Europe than they are in the US. So we do think that you're going to see that divergence. And it's something that macro investors can position for. It's one of the reasons why we are overweight European rates relative to rates, say, in Japan, where the central bank is actually going in the opposite direction.
Gurpreet, appreciate the update on the outlook. Enjoyed the read. Reach out directly to Gurpreet Garewal of Goldman Sachs if you want to read more on that. Up next on the programme, Sam Stovall of CFRA. We'll speak to Howard Lutnik of Cantor Fitzgerald, Julian Coronado of MacroPolicy Perspectives, and Krishna Memani of Lafayette College from New York. This is Bloomberg.
The market is underestimating the strength of the U.S. consumer.
I think the consumer is as strong as it's been.
As long as the consumer is spending, we will continue having a strong economy.
The evidence suggests it's an economy that's pretty resilient.
It's really the U.S. that is driving the world economy right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning for our audience worldwide. Equity futures here, nicely positive, up 0.1% on the S&P 500. A bigger move on a Russell, up by 0.8% on the morning so far. The bank earnings, so far so good, including Morgan Stanley about 30 minutes ago. Upside surprise, beat across the board for that particular bank. Later on this week, the big focus will be on one thing: retail sales tomorrow morning at 8:30 Eastern Time. The next big check of where the US consumer is, and a decent read on how this economy is set up going into election month next month. Lisa, you sat down with the San Francisco Fed President Mary Daly just yesterday. What were the big takeaways?
Well, it's exactly to that point. When I asked her about payrolls and how messy they could potentially be next month, what she had to say
was she doesn't ever place the full emphasis on payrolls, and that there is a broader suite of data, including her conversations with people in her districts, about what they're seeing on the ground, how difficult it is for them to hire people, whether their firing plans have made it closer to the desk. A big question also about how much of a disagreement there actually was on the FOMC, basically saying that there is quite a bit of disagreement that might not be reflected by the vote simply because people didn't think strongly enough to really make a point with some sort of veto or dissent.
She said it was about recalibration, and I feel like they're all keep using this word recalibration. It feels like the new transitory of this Fed right now, recalibrate to get to neutral. When it comes to jobs, though, Citi's out with a new report ahead of tomorrow's jobless claims. They say it will probably take at least the next two jobs reports to shift the narrative back towards risk of a downturn. Weekly jobless claims data, which showed layoffs in Ohio, Michigan, which is interesting for this election, will remain in focus in the near term.
Well, this is to get a read on the U.S. economy. We're getting a read on the Chinese economy, that's for sure, in the last 24 hours. LVMH, 5-day losing streak in Paris trading. We're down another 4-5% just this morning. Over in Europe, ASML in yesterday's session down by almost 16% and down again on the day in Dutch trading.
You know, there are 2 points about this. First of all, just how connected are some of these, particularly European countries, and the European companies, to what's going on in China. But taking a step back, it's also highlighting the potential depths of how much of a downturn there was in China going into this stimulus, and just how much that stimulus is really going to help support companies around the world.
Coming up this hour, we'll catch up with Sam Stovall of CFRA as chip makers slam the brakes on the recent stock rally. We'll speak to Howard Lutnik of Cantor Fitzgerald on Trump 2.0 economic policies, and Krishna Memani of Lafayette College on the Fed's data predicament. We begin this hour with stocks looking to recover following a shakeout in the tech sector as much weaker than expected earnings from Europe's ASML weighs on investor sentiment and triggers a sell-off in chip makers around the world. Joining us now to discuss, Sam Stovall of CFRA. Sam, can you give us your thoughts on ASML? Is that an ASML problem or a broader tech problem?
Good morning, Jonathan. I think right now the expectation is it's more of an ASML problem, but certainly when the expectations have been as robust regarding the semiconductor chip area as well as the equipment area, and with the bar being set fairly high for these groups, I think that there is the likelihood that there could be some disappointments along the way, yet we still believe that 12 months down the road, technology in general, semiconductors in particular, are likely to be market outperformers.
Well, Sam, I can think of one very specific example, NVIDIA. It doesn't take a lot to spook NVIDIA, given the rally that we've seen so far year to date. Yesterday was no different. The stock was down by almost 5%. That's a $160 billion move. That ain't nothing if you're looking at the situation with NVIDIA. Sam, when you look at that name, close to an all-time high still, we had an analyst on the program who said yesterday, yes, the stock's at a record high, but valuations aren't. You can stick with this, you can buy it. Do you want to stay with the winners?
Yes, I want to stay with the winners. I want to stay with NVIDIA. We have a buy recommendation there. We have a strong buy recommendation on Marvell. So our belief is that we're going to be seeing some pretty good growth. 38% is what's expected to be shown in this third quarter for the semiconductor group within the S&P 500. This year, 52% growth. Next year, 42% growth. So a lot of the analysts are looking to 2025 and 2026 earnings, which is going to be an additional 20% growth in this area. Certainly, the rate of change is slowing, as I just indicated, but our belief is that we are still very early in the innings of this sector.
Based on that, Sam, can we use these terrible words that people tend to try to avoid? This time is different, given the fact that you pointed out that typically when you have a 2-year bull market, and you do wish the 2-year bull market a happy birthday, the 3 following years really come with some pretty tepid upside gains. Do you think this time is different because of the leadership from some of these tech behemoths?
Possibly, Lisa. Well, just to summarize what you were introducing, we've had 11 bull markets since World War II that celebrated their second birthday. On average, the third year, the market has been up an anemic 2%. With 3 of these 11 falling into new bear markets, 2 of those 11 posting declines, but not enough to be called bear markets, and 3 more showing gains that are 6.6% or less. So pretty weak returns. Only 3 times did we have something worth writing home about. And what is consistent this time with those 3 that did well is earnings growth expectations. 13% plus is the expectation for the coming 4 quarters, so meaning through September of 2025. We're looking at double-digit growth in earnings, whereas we were seeing more of earnings growth, about half of that in the average 3rd year since World War II.
And I'm struck by not only just the tech earnings and what people are expecting going forward, but also the bank earnings we just got. And not just because they were beats across the board for the banks, but the fact that they seem to open to the idea of potentially expanding some of their lending books, potentially expanding risk as they try to capture on the upside of some of these rates. What does that do to your impression of smaller businesses, of the rest of the 493 names, and the potential there?
Well, if they're willing to capture more risk, then what it means is that they are sort of opening up the floodgates a little bit more for the mid and the small cap stocks so that they can borrow and expand their operations. Because right now, mid caps are trading at a 28% relative PE discount over their long-term average. Small caps trading at a 32% relative PE discount. So certainly with us now likely to be avoiding a hard landing, maybe even avoiding a soft landing to no landing, that would be beneficial to the mid and small cap stocks, especially if their lenders are more willing to do so.
You've been consistent, but this narrative seems to change every other week. Sam, appreciate the update, sir. Sam Stovall of CFRA. Some outperformance on the small caps this morning. For the mega caps, the large caps on the S&P 500, just about firmer by almost 1/10%. With an update on stories elsewhere this morning, with your Bloomberg Brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Morgan Stanley shares up 3 1/3% in the pre-market. The bank posted a beat across the board for its 3rd quarter earnings. Revenue for the bank's trading, wealth management, and investment bank divisions all topping expectations. Net interest income coming in at $2.2 billion, well above estimates. Morgan Stanley also reported that its total client assets have now surpassed $7.5 trillion. Vice President Kamala Harris and former President Donald Trump remain neck and neck in the latest presidential poll. In a nationwide survey conducted by Marquette Law School, Harris leads Trump 48 to 47% among likely voters. The poll has a 4.7% margin of error. Election day is 19 days away. And stargazers are in for a treat this week and this Halloween season. This month's supermoon will be one of the closest ones of this year. The supermoon will be 222,055 miles away tonight and reach its full lunar phase tomorrow. In addition to it looking bigger and brighter than previous ones, this supermoon will be accompanied by a comet, causing a rare stargazing activity and opportunity for spectators. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, the morning calls. Plus, Howard Lutnik of Cantor Fitzgerald on Trump 2.0 economic policy. Must watch. Up next on the programme, live from New York. This is Bloomberg. Equities on the S&P 500 just a little bit firmer, up by close to 0.1%. In the bond market, that rally continues. Had 4 weeks of yields climbing on a 10-year. This week, they're pulling back. We're down about 3 basis points on a 10-year, just about holding on to a 4 handle on a 10-year yield. Let's get you some morning calls. First up, Citi removing ASML from its European focus list, saying its 2025 sales outlook now looks too high. Next up, Telsey Advisory cutting its price target on LVMH, citing its disappointing organic sales decline. That stock is down by close to 5%. And finally, Barclays raising its price target on United Airlines to 75, noting better than expected earnings, but warning the US election may hurt demand. Sticking with the election, Donald Trump, the former president, defending his economic proposals, including more direct control of the Federal Reserve.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do? I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all.
Trump sidestepping whether he would replace Fed Chair Jay Powell before his term expires in 2026. We get lucky this morning. Joining us now is the Cantor Fitzgerald CEO, Howard Lutnik, also serving as co-chair of Trump's transition team. Howard, it's good to see you, sir. Welcome.
Good to see you.
This is a big job, and I don't think people outside the United States realize how big this job actually is. So let's start there. Walk us through how big this position is for you and how busy you might be in the next few months.
All right, so the President of the United States gets to put 4,950 political appointees into the government. So 3,700 can take the field on January 20th, and 1,200 go through the Senate confirmation process, which takes a long time.
So you've got to start thinking about people like yesterday. So let's talk about that. The last time the president was in the White House, he attracted a lot of talent. And we can think of several names. Ambassador Lighthizer came up in a conversation with Bloomberg yesterday. That's one. Gary Cohn's another. Some of the nominations to the Federal Reserve too, including Governor Waller to go to the board. Came with a lot of churn, though, at the time in the first term. How do we get one, attract the talent, but avoid all the churn at the same time? How's the approach going to differ this time around?
Well, remember, last time he was a freshman. You know, he comes in the first time. He's not really sure exactly how it goes. And so he acts a certain way. Now, complete experience, complete knowledge, knows exactly what he wants, and how he wants to do it. So what'll happen is you're going to see the greatest set of talent ever walk on the field on January 20th. You've never seen anything like it. So what I've done is I've talked to probably the top 150 business people across the United States of America, and probably the top 50 political people, and they've analyzed everybody. And what they do is I call it genealogy. You go to these people, so it's 200 people. They then recommend and vouch for everybody. You have to vouch for them and say, I know them, I've worked with them, and then they vouch for it, and it goes down like that. And so we have 5,000 people already that we know who have been vouched for by the greatest people. You got Ross Perot in energy and Chuck Schwab doing finance, and everybody, they are helping, they're building, and they're creating for Donald Trump the greatest group of people who will ever walk on the field for an administration. He's got one term. I mean, I spent Sunday 2 hours with Elon Musk. I mean, that's pretty cool. I mean, I put out a tweet talking about what we did, right? I mean, you know, I'm a social media star, of course, right? You guys know. 43 million views talking about how we're going to pay for everything that Donald Trump talks about, right? He's going to take $1 trillion out of the budget deficit a year because we waste. We have a $6.5 trillion budget deficit. We have a $6.5 trillion budget, $2 trillion budget deficit.
Howard, can we get back to the experts, though? Do they have to agree with everything the former president says?
I think it's like, if you think of it like a CEO of the company, he's the CEO of the United States of America. Let's call it United States Incorporated, okay? He's the CEO. You can argue all you want and discuss it. But when the boss says this is what we're going to do you have a problem doing what the boss says they're going to do? You always have two choices. You can quit or you can execute the plan. This concept of doing what you want to do because I don't think he's right, throwing banana peels, you get fired in America, you get fired at every company, and the fact that all these people who he fired in the first term say, oh, I don't like him anymore, this is the famous disgruntled employee. Duh. Let's call all the disgruntled employees, and what are you going to get from them? Oh, I don't like that guy anymore.
Because you said to the Financial Times, we're going to give people the role based on their capacity, what you're saying here, and their fidelity and loyalty to the policy as well to the man. Is that how you run your company? People have to be loyal to you?
Absolutely. Imagine working at Cantor Fitzgerald and saying, I'm disloyal to Howard Lutnik. Or
but
better,
can they disagree
how about all
with
of you? How about all of you look at the screen and say, to heck with Mike Bloomberg. Let's see how that goes. Well, you'll be like, ta-ta.
Can they disagree with you?
You must disagree, but that's called challenge and conversation. That's what the Oval Office is all about. You bring in 5 people. I mean, Donald Trump loves conversation. He loves to get all sides of the idea. But then you make your choice and you go where the elected president of the United States of America goes. You go where Mike Bloomberg goes. If you work at Cantor Fitzgerald, you go where Howard Lutnik wants you to go. And anybody who says otherwise, I don't even know what they're talking about. This is like make-believe politics, right? You follow the man and you follow after the conversation, but you have to have fidelity to them. None of this nonsense.
This is your opportunity to talk about it, so let's talk about it just a little bit more. You talked about how many people you've had discussions with to fill some of these spaces. How much of them will come from private industry? Is that going to be a big emphasis for you and the team?
It is. And so my ideas that we talked about with the president, obviously everything I do, I'm just sort of the mission for the man, right? Is let's go get the people who understand business, understand the math of $6.5 trillion, couple them with, have them partners with people who deeply understand government, then get really, really good, deep insiders of government, and together create a team, right, to go take the field together. So imagine you spend $6.5 trillion, and we have $1 trillion of waste. So Elon Musk and I, we discussed $1 trillion of waste and billions, tens of billions, and then hundreds of billions of money we can make. You heard Donald Trump talk about tariffs. $500 billion of revenue will come from tariffs.
I want to just dig into what you just said. $1 trillion of waste. What will be cut?
What will be cut? You have monopoly providers. For 50 years, we buy the same product from the same company. For 50 years in a row. Just imagine NASA for a second, shall we? Right? $8 billion human budget, right? Just like paying people.
You know, there's an obvious follow-up.
Do you know that
Yes.
SpaceX spends $12 billion, they
Howard,
launch rockets.
The obvious
NASA
follow-up
spends $8 billion.
is the follow-up that
and they
I
don't
would
build a
ask.
thing.
We can keep doing this. I'll just keep going too.
So let's have fun.
The obvious follow-up that I would have is the same one that I'd have for anyone who came from the Harris campaign. I'd ask them the following. You had 4 years. Why didn't you do it then? Why is there that much more to cut now? Why didn't this happen in the first 4 years?
Oh, I don't think he understood the scale and scope of the rot. He started calling it the swamp. Like we all call it the swamp right now. Why? Why do we call it the swamp? Because he called it the swamp. The problem is it's not really that, it's just these employees of the government are part of the business of spending, right? It's like if I spend and I assist, like I make, the most you can make in the government is $183,000. All right, so I'm making $183,000, and I participate in giving this project of $20 billion, $10 billion to these 3 companies, right? And I work here for 5 years. Where am I getting my job next? I go to one of those 3 companies, and then I make a lot of money. So they all become lobbyists. The generals become lobbyists. All these people. The Defense Department spends $1 trillion, and they don't make the stuff. They buy it. From other people.
You said that it's important to have a lot of people who are in business come into the administration.
Absolutely.
A lot of people in business think that the plans as laid out are going to increase the deficit dramatically. They don't see how this actually decreases expenses, especially with tariffs that could potentially slow international trade, but also with the prospect of a lot of tax cuts. What are they all getting wrong?
So the tax cuts are already in the current world. Right? He's just going to make permanent the 2017 tax cuts. And then, so that's number one. Number two, he's going to encourage people to build here and pay taxes. Let's go over what Apple does right now. Here's a simple example. They make the parts in China.
Yeah.
They put the parts together in Taiwan. Then they wave their magic wand and it floats over Ireland. Of course it floats over Ireland because that's where Apple does its products. And then it comes to America and they make, I don't know, something like 3% profit in America. They pay corporate tax on 3% profit in America. And Ireland announces a massive budget surplus for their 5 million people. Ha, ha. So it's just not true. So the concept is have them pay their taxes in America, and that is how you fix America. You make it fair, you make it right, and you build
This is
here
important. So
and
no
here.
exceptions for Apple. No carves out for Apple.
There shouldn't be carve-outs for Apple. I spoke to Elon Musk and I said, if we do this correctly, Tesla's going to have to pay more tax. You know what he said? If everybody's the same, that sounds great. He goes, I can't do it differently at Tesla if other companies are doing it. But if we're all the same and we're all paying the fair tax, then I am all for it. And I think everybody's all for it as long as it's, you got to get rid of the arbitrage. Why is Ireland announcing a surplus?
So,
give me a break.
So
it's all our business.
15% is the corporate tax rate, the
If you build
president,
here.
if you build here.
If you build it here.
100%? Any inputs from other countries? What is the nuance to making product?
I spoke to a manufacturer. He says he does 50% here, 25% in China. How do we do it? If you tariff me in China, the Chinese backed companies that will cover the tariff, so we'll get the money, but he'll be at a disadvantage. And we came up with this idea. If you build it here within 2 years, you can have a tax credit for any tariff you pay, as long as you move your plant within 2 years to America. You can have your money back, but build it here. See, American workers just haven't gotten a fair shake. Do you know American workers' life expectancy is 7 years less if you don't have a college degree than if you have a college degree? How is that possible? Because if you gut their factories and you take their jobs away, right? You know what it is? It's despair. It's despair. It's not the air. It's not the food. It's despair. Finally, Donald Trump is saying, I'm going to take care of the American worker. And anybody who comes up with this nonsense of that it doesn't work is just not actually studying it.
One thing that a lot of business leaders who I speak to are concerned about is they need stability. They need to have a sense of what the policy is. They need to have a sense of what the legal system is going to be for them to operate their business. One of their biggest fears right now with Donald Trump is that they're not going to have that certainty, with things being used as potential carrots or sticks to try to induce certain policies and a lack of understanding of what the structure is. How do you counter that?
I counter it with basically straightforward, let's protect the American workers, okay? Let's build in America. Let's make it fair so the arbitrage where Apple doesn't run all their profits through Ireland, pay America their money. I think America could increase its revenues $250 billion a year by paying attention to the nonsense that corporate world does on global production. It's nonsense that Ireland makes money. It's nonsense that you build cars in Mexico. It's nonsense.
So, okay? Howard,
and the nonsense ends, you will be shocked by how great America is. You take $1 trillion of waste out, and then you focus on the country fairly. You're going to have the possibility of balancing the budget of the United States of America at the end of his term. No nonsense. I'm not making up old baloney. Elon Musk and I, if you don't respect the two of us, good luck to you, okay? It can happen because he's focused on not wasting the vast waste that is our budget and the way we run things.
That would be a big hole to fill and quite an accomplishment given the tax cuts that are on the table in this campaign. So we could talk about this all morning. We're out of time. It's good to see you. Great. A spirited conversation, as always, with Howard Lutnik of Cantor Fitzgerald. Up next on the programme, we'll look ahead to retail sales. We'll catch up with Julian Coronado of MacroPolicy Perspectives and Krishna Memani of Lafayette College from New York City. Good morning. Wrapping up earnings on Wall Street and basically no drama across the board, completing things this morning with Morgan Stanley. Equity futures on the S&P 500, 1 hour out from the opening bell, firmer by 0.1%. Similar move on the Nasdaq. Russell doing quite nicely this morning. The small caps up by 0.9%. With 60 minutes until the cash open with your morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Let me show you exactly what Morgan Stanley is doing this morning. Up 3.4% in the pre-market trade. Beats across the board. Investment banking, trading, the crown jewel, wealth management also coming in strong, seeing over $7 billion in revenue and $7.5 trillion in assets for Morgan Stanley. So just a win. Again, another strong results from the bank. Also tracking this morning, Intel to the downside, down nearly 1.5%. You'll recall back in September, Qualcomm had made a preliminary approach about a takeover of Intel with all of its struggles. Qualcomm now, according to sources, say it wants to put the hold on this until after the American presidential election. It's unsure about antitrust, about relations of China, which are important for both companies. So the wait is being put on hold. Intel down in the meantime. Finally, Novavax, the biotech company, a huge decline for them, one of the biggest, 15% or so. They had a clinical application in for a combination flu and COVID vaccine. That is now being put on hold by the FDA because someone suffered what's called a serious adverse event. It was related to a motor neurological issue. The chief medical officer at Novavax says that he doesn't see any causality between the trial and that serious adverse event, and he's going to expedite getting the FDA the information to pick that trial back up again. John.
One to watch into the opening bow. Danny, appreciate it. Thank you. This time tomorrow, we'll be looking at one thing, in fact, two. One is retail sales, the other is jobless claims, looking for clues on the health of the US economy and the Fed's path ahead. Julian Coronado of MacroPolicy Perspectives writing, Fed speakers since the better-than-expected September employment report have expressed no regrets on the 50 basis point initial rate cut, stressing that it reflected a need for recalibration. The Fed is right to recalibrate when times are good, rather than wait for mass layoffs. The brilliant Julia Coronado joins us now for more. Julia, welcome back to the programme. It's been far too long. Let's talk about the next jobs report, not the last one. Governor Waller's all come out already and set the bar just a little bit lower, given some of the effects we could get from hurricanes and a strike over at Boeing. How much lower do you think the bar needs to be reset going into November?
Look, I feel like a 25 basis point rate cut by the Fed in November is pretty much, I don't want to say a lock, that's too strong, but the bar is very high to deviate from that. The data is going to be messy. We all know that. It's going to look weaker than it actually is, and it's just going to take some time to sort it out. I think the Fed has seen enough in the backward-looking data that the economy is solid enough that they don't need to worry about it falling off a cliff, but nor is it overheating in a way that they need to maybe consider a pause. So I think we're still 100 basis points at least from any concept of neutral. They don't need to be in a hurry, but nor do they need to be overly cautious or reactive to any inflation print.
Waller did put a number on it. He said it could be around 100K. We could take off 100K from the number. Are you in a similar ballpark with you and the team? Is that what you're looking for?
Yeah, I mean, it's hard to calibrate right now. Honestly, we're still gauging from jobless claims and other reports about how much disruption there's going to be. It's very limited ability to see that in advance. So again, it's just going to take some time, but 100K, I mean, certainly given the Boeing strike, which we can calibrate, that sounds about right. Somewhere in that ballpark. It could be bigger, it could be smaller. And then it'll wash back in the November jobs report. So we're just going to have to see how that sort of nets out over time.
Julia, what are you looking for in retail sales tomorrow? And I say this, especially after bank earnings that demonstrate just how solid consumers are and the ability that they have to actually continue to lever up.
Yeah, lever up is an interesting term. Consumers really aren't borrowing excessively. Debt to income, actually, in the latest flow of funds report went down. So this is not a consumer that's necessarily relying on debt to finance its spending. I think what we have is a dual consumer sort of increasing divide in the consumer sector, where you've got people that maybe didn't get as big a raise this year. They've got a tailwind from inflation, but they're very budget conscious. We hear that from retailers. So they're spending, but very cautiously. And then we've got the upper end of consumers who are feeling really good because net worth is very high. Financial conditions are easy. And they're maybe spending a little bit more, but they also have the means to do so. So on balance, you've got a median consumer that's probably a little bit more stretched than they were a year ago, maybe a bit more cautious. But on the other hand, you've got high-end consumers that are doing just fine, thank you very much. And that's enough to power the economy forward. So we've had a string of very solid retail sales reports. There's no signs that we're of some sort of imminent collapse. I think expectations for the holiday season are that it'll be fine, not a blowout, not a disaster. So I think the economy is kind of in a good, solid zone.
Which is certainly what we're hearing reflected by a number of Fed members who want to keep it that way and want to keep cutting rates in tandem with inflation coming down, which really brings me to this question of why do you think that people are so confident about the path of disinflation now versus, say, a month ago? What has changed to make the prospect of inflation remaining at this level or actually to go higher? Why is that now off the table?
I wouldn't say it's off the table. I would just say the chances of that keep going down. The composition of inflation, and I think President Daley noted this yesterday, one area that's really improved this year is supercore inflation, particularly in the Fed's preferred PCE measure, really has kind of come off that stickiness. It was in the sticky zone. It wasn't clear how quickly that would moderate. We are seeing progress there. We are seeing progress gradually in the shelter component and housing inflation. So just the composition of inflation looks a lot better, a lot healthier, a lot more like it did before the pandemic. And so the risks of it getting stuck too high are just going down. And then if you think about things like commodity prices, look at how many global shocks we are absorbing, one after another. And yet commodity prices really, it's the dog that hasn't barked this year. It's gone up and it's gone down, but really we're still in the same zone on energy prices we've been all year. So yes, there's risks, always risks. But I think a cooling China has really taken the edge off of what we might have otherwise seen in terms of input costs coming through from those global shocks.
Julia, we are less than 4 weeks, about 3 weeks away from the U.S. election. And a big question is, the U.S. is on solid footing, but how different are the scenarios in terms of the policy frameworks after November 5th? What are you looking for? How different could these two economic scenarios be, according to your models?
Yeah, it's an unusual divide for, most presidential elections. It's a little bit around the edges, right? A little bit more tax cuts versus spending. We're talking about a very different scenario in a Trump 2.0. A Trump 2.0 wouldn't look like a Trump 1.0. The staffing wouldn't be the same. The blueprint for policy is certainly a lot more extreme than what he was able to do in his first term. I see it as a pretty disruptive scenario. His plan is to invoke a global trade war from the get-go and to be, turn off that flow of immigration that's been quite a tailwind for the macro economy. And not only turn off the flow of new immigrants, but even mass deportation of current immigrants. And that really has been the saving grace of the U.S. labor market. So under a Harris administration, I think we keep rolling along. It's pretty much status quo. The composition of Congress is going to matter a lot under either scenario. But I would say, the Trump 2.0 scenario is a much more uncertain scenario, much more disruptive, not just for the U.S., but for the global economy.
Julia, appreciate your view. It's good to catch up. Julia Coronado there of Macropolicy Perspectives. Looking ahead to the economic data tomorrow morning, 8:30 Eastern Time. Jobless claims and US retail sales. With us around the table, Krishna Memani of Lafayette College. Krishna, good morning to you. You think the Fed's got itself in a tough spot? Why?
I think when they keep talking about data dependency, it's a problem. Rates are not at 3%; they are at closer to 5%. Inflation is meaningfully lower, if not trending lower. Worst case, it's stable. In that scenario, they have plenty of room. So I think talking about data dependency for the second cut gets themselves in a position that they have no reason to be in.
Governor Waller brought up the prospect of this jobs number being a whole lot weaker. And he also pointed to the fact that the jobs number drops in a quiet period. The quiet period has been a bit of a problem for this Federal Reserve. He even acknowledges that and basically alluded to it, that he hopes other people will pick up the mantle and explain why the jobs number is so much weaker than it may well have would have been. Now, I'm wondering whether we've got a problem here. And if the problem is the length of the quiet period or the problem that data point dependent, we need to come out and explain in the quiet period what's actually happening. Which one is it?
So I think this series of data is going to be so messy that deriving any information out of it is going to be tough. It's going to be, anyone who kind of comes up with an explanation is basically trying to come up with something to fit their priors. That's how it'll definitely play out for them. But I think after cutting 50 basis points in the last go-around and having laid out a path in their SEP as to what they are going to do, doing something very different based on this data set, I think will probably show their muddled thinking more than anything else.
At this point, does it matter? If they cut rates again this year, is that basically just going to support this bid into equities? Because ultimately it will just show that this is a Federal Reserve that has a bias toward cutting rates, wants to see a durable landed economy, and frankly, it sees a lot of room to cut.
Well, so none of that is wrong, right? This is a Fed which is hell-bent on cutting rates because rates are too high. And things are going their way, and they want a soft landing. So if that's how they execute, that's what they have laid out in the SEP. I don't think you can hold the Fed, hold that against the Fed, because it is the right policy move in the current context.
So where's the uncertainty for stock investors? Where is sort of the lack of clarity around the Fed's path of travel and where they're going that will make certain data points more important than others for people who are bull on?
Well, so I think the path of the Fed over the next few quarters, I think, is pretty well determined given where rates are and where inflation is. And I think what would be uncertain for it probably is far more uncertain for bond investors than it is for equity investors. I think equities, as long as growth is decent, profitability is good, and the Fed is inclined to cut rates rather than raise rates, I think that path is pretty defined. It's really the bond investors who have to worry about, which is, is 4% the right level for bonds in the current context if inflation picks up slightly because of slightly better growth and slightly better employment levels? I mean, that doesn't change the equity outlook. That changes the bond outlook meaningfully.
Do you think about it in the context of the U.S. economy or the global economy?
Well, so I think that Julia was making a really good point, which is the U.S. economy is able to kind of drive itself, or the markets can drive itself off of the U.S. economy because the global shocks are very well contained. That is, there's nothing really happening in Europe. There's really nothing happening in China that is meaningfully different than the trend that we have seen. So I think from that standpoint, our markets, we can figure out where they are going based on the U.S. economy and the U.S. rate.
Well, this is what I'm trying to figure out. The U.S. economy can basically operate as a bit of an island. Mm-hmm. We're talking about a global fixed income market, and what happens in Europe, what happens in China, has some consequences for where that 10-year yield trades, surely.
Oh, absolutely. I think if China was going into a deflationary cycle and they were not doing anything. Yeah, well, it is, but the path of deflation is much slower than I think we have imagined over the last few years. And they are they're not doing much to revive it, but they're doing something. So in that context, thinking of a savings glut and taking rates to 2%, I don't think that is in the cards anytime soon.
At the same time, does it make you very confident on being bullish the dollar? I do wonder, based on your call and based on some of these rate differentials, whether that's an increasing kind of focus for people.
Well, I think if the U.S. dollar is going to remain strong, it is going to be because the U.S. economy continues to do well rather than level of rates. So I think I sincerely believe that because the difference between the U.S. economy and every other large economy in the world is so substantial that in that context, unless we screw it up royally from a policy standpoint in the new administration or something, or in with respect to the Fed, I think the dollar has enough support from the economic picture that we are seeing unfold in front of us.
So what are you doing right now?
Well, so, what we are doing is basically nothing, which is, and there's a reason for that, is because, the way you don't do anything is actually expressing a view, which is you're not, if along with not doing anything, you're not rebalancing.
Are you just holding on to the desk, as Julian Emanuel told us, and waiting for the election to be over?
We are looking at the screens and feeling really good about what the equity market is doing and not cutting the equity exposure as equity exposure has increased.
You're allowing the equity portion of the portfolio to take on a bigger role in the overall portfolio, correct?
Exactly.
And why are you so much more comfortable with that?
Growth. I think yesterday when somebody asked Moynihan whether it's soft landing or no landing, I think he was basically saying the same thing for both scenarios, which is I don't think people confuse soft landing and no landing. It's really the same scenario. It's exactly, as long as that continues to unfold, I think we are in a good shape.
We typically talk about a 60-40. Are you questioning the risk mitigation characteristics that Treasuries can provide, given the risks on the table into 2025?
I think Howard answered that question for you when he was here. With the plans that they have, if those unfold, I think the uncertainty with respect to bonds is quite substantial. And I think counting on bonds to provide a significant level of counterweight to your equity portfolio, I think cash does much better than bonds in this context.
Are you saying that essentially the reinflation risk is the biggest potential risk right now, that potentially is a difficult one to hedge against, other than just going again into stocks?
Yes, I think for bond investors, the reinflation risk is basically unhedgeable at the moment. That is, you can from a short-term perspective, you can probably put on some hedges, but that's not going to solve your real long-term political problem that you'll be facing. So
I'm pleased you've said this. This is refreshing, and I'll tell you why. We've heard a lot of boilerplate nonsense on this program around the election. A lot of people coming on and saying it won't make much difference. Look back to previous election cycles, stocks go up to the right. I think this is very, very different. What's on offer here? And I'm not going to say which one's the better one. The American people get to decide that. But there are two very different visions of policy in America for the next 12 months, surely.
Oh, absolutely. I think, and Julia was kind of addressing that particular issue, that the two policy paths are very, very different. They may have the same outlook for equities. They sure as hell are not going to have the same outlook for bonds.
So let's look at a Kamala Harris for the bond market.
I think Kamala Harris for bond market is probably not as bad as Trump for the bond market if the current set of policies that are on offer get implemented.
Krishna, it's good to see you. Thoughtful stuff. Thank you, as always. Krishna Memani there of Lafayette College with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of LVMH slumping more than 4.8% in the Paris trade. It reported an unexpected drop in third-quarter sales and warned of an uncertain economic and geopolitical environment. It was the first sales decline since the COVID-19 pandemic, driven by slumping Chinese demand. Vice President Kamala Harris is leading in political donations, but former President Donald Trump has picked up some big-name support. Elon Musk poured $75 million into the super PAC he created earlier this year. Billionaire Miriam Adelson added $95 million into her super PAC supporting Trump. And venture capitalist Mark Andreessen and Ben Horowitz each donated $2.5 million to a pro-Donald Trump super PAC, according to the latest filings with the Federal Election Commission. And Citadel founder Ken Griffin has found a buyer for a Chicago penthouse, but the sale will come at a loss. Griffin is selling his 7,500 square foot 38th floor property for $11 million. He bought the unit back in 2017 for around $21 million. He had spent nearly $60 million on the penthouse, along with 3 other units in the building, in what became Chicago's largest real estate deal in its history. Griffin, though, never lived in the home. That's your brief. John.
I think Kenny G's going to be okay. I think he's going to be all right. Kenny, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. You're watching Bloomberg TV. From New York, 39 minutes out from the opening bell. Equity futures shaping up as follows on the S&P 500. Just a little bit firmer, much more so on the Russell. The small caps up by 0.75% in the bond market. Rally on. Yields lower. 10-year down by about a basis point, down by close to 7 basis points in yesterday's session. Closed, of course, on Monday. The move yesterday encouraged by what was happening, not just in the equity market, the risk aversion, but also developments in the commodity market. Leads to a drop of more than 4% on Tuesday's session. On Monday, we were down more than 2%.
Real questions around what any kind of retaliation would be from Israel toward Iran and how that would affect the oil patch. A lot of back and forth, though, about is this going to be supply disruption driven or is this going to be demand driven? And that's really ultimately what's been toggling with this market.
It looks like at the moment is Israel is willing to not go after these oil facilities in Iran. That immediately pulled the price down. But what did Stephen Cook tell us yesterday? Basically threw cold water on that and said you have to wait. There's no basic end to this potentially, and that still could be another lever they target.
Israel has been going its own way, and it hasn't really mattered on many occasions what the United States says about it. Counting down to the opening bell, here's the trading diary, the calendar. The events to look for tonight, this evening. Kamala Harris sitting down with Fox News for the first time ever for a formal interview. Must watch TV. Tomorrow, an ECB rate decision, retail sales and weekly jobless claims. Plus, we start to get a little bit of tech, Netflix and TSMC earnings. Look out for that. Friday, housing starts and building permits, plus more Fed speak from Kashkari, Waller and Bostic. Next Tuesday, GM earnings. Wednesday, Tesla. Right here around the table, we're still digesting results from Morgan Stanley. Bloomberg Sonali Basak sitting down with CEO Ted Pick at 10:30 Eastern Time this morning. Sonali, a final word. What are you going to be talking to Ted Pick about this morning?
You know, I think about a conversation I had with him a year ago, and he said he wants to be number one in trading and investment banking, and he said it's going to lead the next cycle. They are telling analysts now that they expect that capital markets are going to have a multi-year cycle. What could gum up that cycle? We haven't seen it come back in an easy way. How long before you see those riches really start to flow in from Morgan Stanley?
How do you draw a distinction between just pure execution and just a market that seems to be in a better place for companies like Morgan Stanley and Goldman Sachs?
Well, you look at the margins, I think, for one thing. You look at Morgan Stanley, and you do see their returns coming in higher than Goldman Sachs's. You see their margins in the wealth management business getting better. But what's interesting is if you look at the breakdown, it is just stunning. In pure revenue terms, you actually have JP Morgan and Goldman Sachs coming in above every other bank in every major business line, and the lead is also stunning. So if Ted Pick wants to be number one, my question is at what cost? Because that catch-up game could pay some cost to the margin line there.
Size might be a piece of it. Acquisitions in the timeline, given the fact that that has been a path that they've taken in the past.
Perhaps. I mean, that's something we've seen a lot of Morgan Stanley already do. They've digested a lot of those acquisitions. To the extent they do more, you can't imagine them doing another major one. And, you know, Goldman, we've seen how that story played out. So these acquisitions for banks are not easy. They're distracting in some level as well. So do you want to acquire people, or do you want to acquire talent, acquire businesses or talent? And at this point, we're looking at an investment banking cycle at the brink of coming back, Lisa. It's just there.
So we've wrapped up the big earnings season. What's your big takeaway?
You know, there's a lot less fear under the surface, but you have JP Morgan and Morgan Stanley. I was joking this morning, the Morgans are coming home. They're both trading at 2 times earnings. Guys, is it bad that it's not even 9 a.m. and I'm wondering what the Morgan Stanley cocktail party looks like tonight? That's how well that they're doing.
You're skipping the interview and going straight to the cocktails.
I'm gonna skip those. It's been a long 24 hours, but they have to be celebrating over there. These are standout numbers by any metric. Now, if you're not one of the biggest of the banks, does it look this good? You're seeing that bifurcation continue on even more.
Shanali, it's good to see you. Looking forward to the programme alongside Katie Granford and Matt Miller in just a moment. Look out for this interview, a sit-down conversation. Shanali Basak together with the Morgan Stanley CEO, Ted Pick, at 10:30 Eastern Time. Coming up tomorrow on this programme, we'll catch up with Russ Kostrick of BlackRock, Mohammed Al-Erin of Queen's College, Cambridge, David Leibovitz of JP Morgan, and Dana Peterson of the Conference Board. The Conference Board, the data coming out of that really, really important, the labour differential. Jobs hard to get versus jobs plentiful. They is moving in the wrong direction over there. We'll get Dana's thoughts on that tomorrow morning. As we count you down to the opening bell, equity futures on the S&P 500 just about unchanged, and the bond market yields just a touch lower. We're down a basis point, 4.02% on a 10-year. From New York, that does it for us. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.